Yes, now we see your presentation. So please, Radhika, the floor is yours. It's about the role of urban cooperative banks in financial inclusion.
Yeah.
Please.
So, good afternoon, everyone. My name is Radhika Gupta, and I hold a master's degree in economics. And currently, I am associated with VIII Pilani Hyderabad campus in the capacity of research assistant. Uh, so, so the paper is co-authored by Dr. Minnie P. Thomas, who is working as assistant professor in VIIT Pilani, Hyderabad campus, India. So I will be presenting our paper titled "The Role of Urban Cooperative Banks in Financial Inclusion," an exploratory study of two districts in India. So the paper attempts to analyze the progress achieved by UCBs located in Hyderabad and Rangareddy districts of Telangana state in India in achieving financial inclusion by examining the various supply side indicators. Um, so financial inclusion is globally recognized as a key enabler of inclusive growth for a country, helping and accelerating its progress towards development. It has assumed a policy priority with governments across the world. Uh, in fact, United Nations identified it as having a major role in achieving 7 of the 17 Sustainable Development Goals. In India, it has been firmly placed as a policy imperative by the regulators and policymakers. But despite their concerted efforts, around 20% of population was without a bank account, and almost half of the bank accounts in the country remained inactive, as per Global Findex Database 2017. UCBs, being ingrained within the local community, play a significant role in increasing the outreach of banking services in urban and semi-urban areas. These banks enjoy upper hand in terms of lower establishment and operational costs, building strong relationship with customers, flexibility, etc. over commercial banks, in reaching out to the financially excluded. So now I'll be mentioning few of the important papers from literature review. Um, Kunt and Clapper, using Global Findex Database 2011, found out that 50% of adults worldwide are unbanked, with factors such as cost, distance, documentation requirements, and distrust in formal financial institutions identified as major barriers. Iqbal and Sami, using multiple regression model for the time frame from 2007-8 to 13-14, found financial inclusion to be strongly associated with progress and development of the economy. And they found that number of bank branches and credit deposit ratio have positive significant impact on GDP, whereas the growth rate of ATMs have negative insignificant impact. Um, so it's not moving. Yeah. So then Anant and Onpu, they tried to study the institutional challenges and problems faced by financial inclusion in Andhra Pradesh. And they found that the inability of formal banking sector in delivering financial services to poor has resulted in informal business entities addressing the gap. And they emphasized on the role of public sector and cooperative banks. Nayak, he attempted to understand the feasibility of cooperative banks-led financial inclusion for inclusive growth in India. And he noted that cooperative banks have an upper hand over commercial banks. And significant role had been played by these banks in rural development, which make them a viable option for inclusive growth. So most of the existing studies have emphasized on commercial banks-led financial inclusion. Few studies which have analyzed the role of cooperative banks laid emphasis on rural cooperatives. There is a dearth of studies which have explored the role of urban cooperative banks in financial inclusion, particularly from the supply side perspective. This study adds to the existing literature by measuring the progress achieved by UCBs located in Hyderabad and Rangareddy districts of India in enhancing financial inclusion by analyzing the various supply side indicators. So these two districts are the two most populous districts in Telangana state, with the former having its entire population and the latter with 60% of its population residing in urban areas. So with the majority of population of these two districts residing in urban areas, the role of UCBs becomes even more important in bringing the financially excluded urban poor within the ambit of formal financial system. Uh, Moreover, Hyderabad city has the second largest population of urban poor amongst all the cities in India. Um, we have used both primary and secondary data for our study. Primary data is collected through a field survey of 39 UCBs functioning in these districts for the year ending 31st March 2019. Although all the 39 UCBs have been covered for the study, but on account of non-response and incorrect addresses, data could be gathered only for 30 UCBs. Interview schedule was employed for this purpose, which was drafted to include the supply side indicators of financial inclusion. Secondary data is collected from RBI's database on Indian economy and All India Debt and Investment Survey. We have used probit regression to analyze whether the likelihood of UCB having a branch is affected by variables like total number of accounts and total assets held by it. So the response variable having a branch or not is a binary variable, and total number of accounts and assets, total assets are the predictor variables. A financial inclusion index is constructed based on 3 dimensions of financial inclusion, namely access, usage, and deepening, and is computed with the help of principal component analysis technique. Descriptive tools like growth rates, percentages, and graphs are used to measure the role of UCBs in achieving financial inclusion with respect to the indicators like gender gap, credit deposit ratio, priority sector advances, assets, deposits, loans, number of branches and ATMs, bank accounts, etc. It's not okay. Overview of financial inclusion in Telangana state. So Telangana has been ranked 9th amongst all the 36 states and union territories in India with respect to financial inclusion as per the CRISIL Inclusive 2018 report. As per All India Debt and Investment Survey 2013, urban Telangana, 823 households per 1,000 number of households own a bank account as against 795 at all India level. The number of households having deposits is lower and those having cash loan outstanding is higher for the state as compared to at the all India level. Debt asset ratio is higher for households in Telangana compared to most of the other states and at all India level. Now, an overview of UCBs in Telangana, and this data is collected from RBI's database on Indian economy. So as a result of demonetization, the deposits of UCBs in Telangana grew at 12.8% in 16-17. In 2017-18, a sharp fall was witnessed in deposit growth, and again a substantial rise in 2018-19 was observed. There was a tremendous increase in growth rate of advances in the year 2018-19, and after a fall in the year 16-17 and 17-18. ATM growth and CD ratio for UCBs in Telangana over the years have been higher than that for UCBs in southern region and at all India level. Now, overview of UCBs in Hyderabad and Rangareddy districts, and this is based on primary data. So, in terms of assets, there is a large disparity in distribution of assets among UCBs in the two districts, and this could be seen from Figure 1 that around 64% of UCBs, that is 19 UCBs, have assets less than 50 crores, whereas only 3% of UCBs, that is 1 UCB, has 550 crores of assets, more than 550 crores of assets. Then credit deposit ratio, 12 UCBs have their credit deposit ratio in the range of 61 to 70%, followed by 27% of UCBs, that is 8 UCBs, each in the intervals of 51 to 60% and 71 to 80%. Clientele of UCBs is marked by the dominance of small businessmen, retailers, petty traders, nearby residents, and other middle class people, with slum dwellers and laborers constituting either no or very small proportion among them. In fact, 17 UCBs have none of their customers as either a slum dweller or a laborer. 21 UCBs are not serving micro, small, and medium enterprises or self-help groups. Priority sector advances, majority of UCBs have a percentage of priority sector advances to net bank credit in 51 to 60% interval, followed by 5 UCBs having this percentage in the interval of 61 to 70%. In fact, one of the UCBs has disbursed more than 90% of its net bank credit as priority sector advances. Gender gap in account ownership. So ratio of women to men is only 20:80 for majority of UCBs but a decent ratio of 40 to 60 is maintained by 6 of the UCBs. Gender gap in loan access, this ratio is low for most of the banks. It is 20 is to 80 for 6 UCBs, 10 is to 90 for 5, and 30 is to 70 for another 5.
Radhika, it's 3 minutes to go, yeah?
Okay. Around 1/3 of the UCBs, that is 9 UCBs, are not having any website. Mortgage loan is the most common loan among customers, and it is followed by gold loan. Then Pradhan Mantri Jan Dhan Yojana is being implemented by only 5 of the UCBs. Core banking solution is implemented by all the UCBs in all their branches. Then mobile and internet banking, only one bank has executed internet banking, whereas 7 banks have rolled out mobile banking, but that too only with the viewing facility. Immediate payment service has been provided by 9 UCBs. Direct benefit transfer is not being implemented by most of the UCBs. Then some of the UCBs have a daily deposit scheme under which agents and bank staff reach out to the neighboring people like shopkeepers, petty traders, small businessmen, door-to-door, etc., door-to-door, and collect money from them, open fixed deposits in their names, and after the maturity period of 6 months, these deposits are returned to them. Probit model has been used to analyze whether total number of accounts and assets with the bank contribute to its likelihood of having a branch. So number of accounts does contribute, whereas banks with whereas the total assets does not contribute. A financial inclusion index based on access, usage, and deepening dimensions of financial inclusion is constructed using principal component analysis technique covering all the UCBs. The results showed 4 UCBs have higher level of financial inclusion as compared to the other UCBs, and these UCBs are also the one which have been providing services like mobile banking, IMPS, on-site ATMs, issuance of RuPay debit cards, etc. In conclusion, main conclusions are like in Hyderabad and Rangareddy district, so many UCBs have performed satisfactorily well on certain supply side indicators. All the banks have not performed up to the mark on these indicators. In many other indicators like 9 out of 30 banks are still not having a website. Many UCBs are not serving micro, small and medium enterprises or self-help groups. In many other indicators, overall the functioning of UCBs in these districts has been poor. Like majority of them are not catering to their target clientele. 25 out of 30 have still not implemented Pradhan Mantri Jan Dhan Yojana. Services like direct benefit transfer, mobile banking, internet banking are not carried out by most of them. Ratio of women to men in terms of owning a bank account or having access to a loan is low. So various steps which are being taken by them include daily deposit schemes and maintaining a decent percentage of priority sector advances to net bank credit. So there's no doubt they have been taking many initiatives, but still they have a long way to go in filling the gaps and fostering financial inclusion. Some solutions include effective application of modern technology, use of audio and visual aids for improving financial literacy, special efforts in stepping up account opening for women and deposit schemes for girl child, and introduction of need-based products and services. So that's all from us. Thank you very much.
Thank you very much, Radhika. Again, please, to the others, please keep your questions good in mind, and we will talk about the questions and comments later. Okay, so the next talk, Sovik Mukherjee, you will talk about fiscal decentralization. Please share your screen. And yes, your video is already switched on. Yes. I see that. So please, the floor is yours.
Thank you so much, sir. A very good evening. I'll just start the presentation. Give me a minute. Sir, is my PPT visible?
Yes, it is small but visible.
Okay, I'll try to. I'll try to.
Yes, now it's better. Very good.
Yeah. Okay. First of all, thank you so much. Very good afternoon, evening to all the participants, to all my fellow participants who have joined from across the globe, and thanks to the organizers for having it online this year and giving me an opportunity to present the same. So as my topic reads, is fiscal decentralization a means to poverty and inequality reduction? A comparative analysis for India and China. Now, the first question that needs to be answered is why is the paper concentrating on India and China? I'm giving you a disclaimer. It can be compared between any other countries, a pair of countries as well. But specifically, why we want to focus on India and China is because of some reasons. Now, firstly, there are certain reasons why these countries are very similar, but at the same time, they are dissimilar in terms of their political heterogeneity, the societal or the cultural diversity. So I'll try to point out each area as to how they're similar and how they're dissimilar. Why are we focusing on these two countries in particular? Now, since I come from India and a faculty member at St. Xavier's University, Kolkata, India, so India is obviously one of the countries that I've chosen. But why China and what is the link? Now, firstly, India and China both have introduced reforms, going by the history of economic reforms, sequentially over a period of time, not following the Big Bang approach that developed nations have followed. Many European countries, Eastern European countries, the former USSR have followed. Number one. Number two, both China and India have been consistently devolving more power to the state government, state provinces, not centralizing it, but rather slowly and steadily devolving power. These two are the similarities. Now, moving on, as I have pointed out, the poverty and the inequality position in India and China, it's kind of roughly they're close, but there are obvious differences. One cannot rule out that part. Now, in the second part of the story, I'll just try to focus on the fact that, as you know, both India and China, especially China, they have a remarkable record of economic growth. And as a kind of note, India's GDP has plunged in COVID times. The predictions and the first quarter, the estimates that is being published, 23% contraction, roughly 24% contraction. But on the other hand, it's just a note, nothing to do with the paper, but China is still kind of finding space to figure out its growth somehow. Now moving on to the dissimilarities, I like to point out there are very interesting kind of differences. Now, from the demographic angle, China is the world's largest country in terms of population, but India in terms of is the largest democratic republic. While India is the world's largest democracy and has multi-party elections, China is one-party rule. From the cultural angle, India is ethnically diverse, and you will be kind of, as I move on with the paper, you will follow why I'm kind of focusing on these areas. While China's population is relatively homogeneous in comparison to India. Now, next, what we move on is the research question. Now, why am I trying to figure? First of all, in the literature review that we have, in specifically the Asian countries, fiscal decentralization and economic growth is an issue which has been talked about, which has received attention. But the trivariate nexus of poverty reduction, income inequality, if I punch them with fiscal decentralization, whether fiscal decentralization, giving the states more power and devolution of more resources, can it play a significant role in poverty reduction and income inequality, given that we have this political, social, and demographic dimension? The second research question is obviously, can it backfire? What can be the conditions when this backfires? The third research question is, since you know that we come from a country which has a diverse ethnicity and religious background, so there are around the religious classification of groups that we have from Hindus to Muslims to Christians to Sikhs to Jains to Buddhists, 8, 9 classifications we have. So we have this in mind that can there be a social tension arising out of this poverty and income inequality. Now this has another literature in the context of India. So I'll focus on that in a few minutes. Now, next is I'll not waste much time in the literature review because mainly the papers have focused on fiscal decentralization and economic growth. Now, what I want to focus on is not really fiscal decentralization and economic growth per se, but along with that, the role of poverty reduction and income inequality reduction. That's number one. And this issue has not been talked about, particularly in the developing economy context. So this makes it more relevant, and definitely one can refine the structure. Now next is I'll move on to the methodology for the construction of fiscal decentralization. Now what we do is simply rather than going for World Bank's one particular ratio, we punch in 4 ratios. Now, I'll just take a minute to explain these ratios to you. The first ratio, expenditure ratio, it basically measures the share of spending taking place at the subnational level, means at the state level that we have in India and the provinces that we have in China. Now, this is integrated across all the states. If you look at the formula, the J states have been summed over. Now, the I stands for the counter, whether it's India or China. And J means the provinces of the states that we have internally within India or China. Now, you will appreciate the fact that higher expenditure ratio means that there is a higher degree of decentralization. It means that a high decentralization of tasks, particularly in terms of collecting revenue and policy prescriptions, the decentralization happens more if the ratio is on the higher side. If I move on to the revenue autonomy, what happens is, again, these are formulas, but I'll take you through the logical explanation. Again, revenue autonomy has a similar logical intuition as expenditure ratio. A higher revenue autonomy means a higher degree of decentralization. Again, the same thing. Subnational owned revenues, you add up across the states. We have 29 states in India. And the grants that a particular state receives from the central government or from any other external body. The third one, transfer dependency ratio. Again, it's similar. The grants that it receives from the central government or from any other external body divided by the subnational expenditure across all states. We punch everything together. But interesting, the third ratio has an adverse interpretation as compared to the other two. How? A higher transfer dependency ratio means the degree of dependency. Try to understand this part. In contrast to the revenue autonomy, this ratio tends to be low in countries which has high degree of fiscal decentralization. They don't depend on the transfers from the government. They have their own resources. So a lower value of the ratio will mean higher value of fiscal decentralization. And last, we have debt autonomy, which again has a similar interpretation like expenditure ratio and revenue autonomy. Now, moving on.
Sovik, just a note, you have a little bit more, but 3 to 5 minutes, yeah?
5 minutes. Okay, sir. Okay. So now what we do is we construct the inequality indexes. Many must be familiar with this generalized entropy measure, but here there is a problem that we face with the data. Instead of getting the mean values, which exactly in the Indian context very difficult to derive, given the NSSO surveys that we have, and the data being a little, we have census data and NSSO surveys data, but not current data. So what we did actually, we used this ratio from OECD, first decile income to 5th decile income, and 5th decile income to 9th decile income. Now this 5th decile income served as the kind of mean. Now moving on, the factors in the empirical model, as you can see, size of the government, the logarithm per capita GDP, adult literacy rate, all are kind of the socio-economic indicators, mortality rate, religious fragmentation, urban population, index of democracy, trade openness ratio, and as I was talking about, poverty-based social tension and inequality-based social tension. So these tensions arise out of one out of the relative measure, one out of the absolute measure. Now, what we do here is this mu is the mean income and G is the Gini coefficient, the way we calculated it. Z is the poverty line, theta 1 is the poverty gap, and mu there is a typo, it should be mu is again the mean income. Now moving on, we basically did a Cornel estimation. I'll not take you to the theory, but rather I'll just focus on the religious polarization part that we have in India. See, if there are two groups, how do we classify this polarization? Let's say there are two groups. So my pi I will be half, 0.5, 0.5, two groups. So that means the degree of polarization is maximum. So when will the degree of polarization be less? When you have multiple groups and the share of each group goes down. If you have a bipolar, that means only two, 50%, 50%, maximum polarization. So this is how we model it, and I'll not tell you the result because it's very time consuming as I'm running out of time. I'll straight away move to the key insights. What we get to see interesting is that all the factors, as I was mentioning, starting from size of the government. Now people question that why do you have size of the government? It's interesting because a larger size of the government, here we use a proxy as percentage of government expenditure as a percentage of GDP to measure the size of the government. Now, what we get to see is that while this significantly affects the fiscal decentralization parameter that we have, I missed out on one thing, the construction of the fiscal decentralization parameter. Below here, if you find all these ratio, we have used a Euclidean distance function to calculate this modified fiscal decentralization index. Now, the amount of shortfall from the maximum target value of 1, you take the difference and you add up all these four values. Now, this is the total shortfall. 1 minus the total shortfall will give you the degree of fiscal decentralization. Now, this is actually, we call it a modified fiscal decentralization because in the literature, we generally don't see the punching in of 4 or 5 indicators with equal weights. Now, moving on to my sincere apologies, I missed out on that part. Now, moving on to this last part and then we'll conclude. First of all, what is interesting is that with a higher size of the government, fiscal decentralization actually worsens the inequality. But it sounds poverty reduction improves, but inequality position worsens. Why? Because we used a cross term to check whether this has got something to do with the government size. If I have a higher government size, what happens is that the ability to push in more social sector schemes, more welfare schemes improves, and there is a degree of reduction in income inequality, which is not possible if the size of the government is less. But as you can see, for China and India, consistent with the data that we have, for sufficiently greater amount of government spending, there can be an improvement in income inequality, but poverty overall improves if there is fiscal decentralization. Now, moving on.
Sovik, you should really now come to the end.
Yes, yes, sir. Just 2 minutes. Just 2 minutes.
1.
Yes. So 1. Okay, done. So what we get to see for inequality-based tension and for poverty-based tension, if we do go for fiscal decentralization, there is to a certain extent pacification of these religious groups. If you punch them with more, if the states have more power, they can cater to the needs of these ethnic groups. Now, what we project again, given the literacy rate, share of urban population, employment rate, that standard results hold good, that you need to focus on welfare driven schemes so that the redistributive effects trickle down to the subnational level, and policymakers should do a cost benefit analysis, because I end with a word of caution: size of the government does matter. The more you can punch in money, that means higher will be the share of the government, central government or the state government, greater will be the impact on the level of poverty and inequality reduction. Thank you so much, sir.
Thanks so much, Sovik, for the talk. Again, I should mention that you should please keep your questions in mind. But I have even better proposal. Perhaps it would be good to note questions already now in the chat. So you could, I mean, to the attendants, I would suggest the following. If you have questions to the speakers, you could simply address the speaker here, question to Sovik or Radhika or whoever, and then you can pose your question already, because then within, during the time, the speakers can read the questions and already think about the answers. So please, everybody who has a question, please formulate the question already in the chat now, because then the discussion session will be more effective. All right, so let me then give the word to Yousef, right, from Nottingham.
Clemens,
Yes.
could you wait a moment? Actually, he hasn't joined. No, he's here.
Oh, yes,
I'm
I have seen him.
Yes,
yeah, I'm here.
Yes, I've seen him. Yes.
Okay, yes, I'm giving the screen to.
Okay.
Hello, everybody.
Okay.
Can you hear me?
Yes.
Yes, and we see the slides.
The slide is clear, or should increase the size a little bit?
Just a little bit.
The full screen.
Full screen
mode.
I think.
If you do full screen mode, it should be fine.
Now, is it okay?
Yes, perfect.
Okay. Hello, everybody. I don't know, good morning or good afternoon, it depends on your location. My name is Yousef Makhlouf. I'm a senior lecturer in Nottingham Trent University. This paper is joint work with Professor Neil Card from University of Essex and Professor Dimitri Vinogradov from University of Glasgow. This paper basically is about income inequality dynamic or trend in the last 140 years. Indeed, several studies in the last few years, they discuss the inequality trend, especially after Piketty book in 2014. Piketty in that book suggests that the inequality decreased in most developed countries since the World War II until 1970, 1980s, and after that, the inequality started increase across most developed countries. This is what we call it inequality rebound. I don't know if you can see my mouse as well. I need it because I want to show you something on the graph in a minute. So inequality rebound conjecture actually is not a new concept. There are other studies before. They call it a great U-turn actually, like Alderson and Nelson in 2002. But what we noticed from the literature, most evidence about inequality rebound actually is based on casual observation of the time series. Casual observation actually, it could be useful in some cases where you have a clear and sharp trend, like the case here, if you can see it for Finland, for example. But sometimes it is difficult for naked eyes to see the trend in income inequality, like you can see the case here for Germany. For example, it's a little bit flat trend. We don't know if it is positive, significant. Is that it's look negative, yes, but we don't know is it significant trend or not. So until now, most of the study actually they use casual observation probably because of the data limitation, and they focused only in a few studies. For example, Piketty, as you know, he focused on basically on France, UK, Germany, and United States. But now we have a data available from some resources for 21 OECD countries for 150 years. That will give us opportunity to find statistical evidence or answer for the inequality rebound hypothesis. By the way, we don't claim that our approach is better than other study, but we do believe that our approach is important complement for the current literature. So this is our first contribution, is to investigate the inequality rebound statistically, estimating the trend for each OECD country in the last 140 years. Our second contribution, actually, we're looking for explanation for this rebound conjecture, for this inequality dynamic. Literature provide actually several potential factors, including globalization, technology, education, fiscal policy, blah, blah, blah. It's a very long list, actually, but we have some study that discuss the view of society. What society believe, is it serious, is it inequality is a serious matter or not? Because that will put more pressure on government and policymakers to reduce the income inequality. Of course, that's in the case if in democratic country, in democratic society. It is not a new idea, but actually we have a less evidence about the impact of social value, because it's difficult to measure comparing with the globalization, technology, blah, blah, blah. It's more difficult to measure the social value or the view of society about inequality. Is it matter now or not? And this is very important challenge for us. And I will explain in a minute how we find possible explanation. I hope you agree with me, or if you are disagree, you can just let me know what you think about this measure for social value, especially we're talking about 140 years. So as you can see, this is our main objective. The first contribution is to provide statistical investigation for inequality rebound conjecture using this long period data set for large sample. And the second is to evaluate the view of society as a potential explanation of the inequality dynamic for this current change in the inequality trend in the last few decades. Data, we use data for 21 OECD countries over the period 1870 until 2011. We use the most two common measure for income inequality, which is Gini index and top 10 income share. The source of this data is Medicine 2016. This paper, it's in Review of Economic and Statistics, and 2018, it's published also. They use this data in European Economic Review, I think. So we use this data set for 21 OECD countries. Our social value measure, we use two different measures for social value, the value of society about inequality. The first measure is trade unions. Union density, actually, it's a proxy for the view of society about inequality, because it reflects the concern of society about income distribution, about fairness. This is based on several study and literature. So when trade unions increase, that means we have a more concern about income inequality and more pressure on the policymaker to change the distribution of the income. So it represents actually the view of society. Indeed, this is not the first study to investigate the relationship between unions and income inequality. There are several studies. They investigate the relationship between union density and wage disparity. But basically, they use survey data for few countries for a few years. As you know, survey data is very limited. And of course, in that case, you cannot explain the current rebound conjecture as suggested by Piketty. So in this study, we'll use also trade union. The source is the same, actually, is Medicine 2006 and 2018, the same source. But here, the problem with this unions measure, actually, let me first show you how the relationship between unions and income inequality look like. This is the average for our 21 sample. You can clearly see here, this is for all 21 OECD countries. You can clearly see it's very sharp trend for the overall group. It's decreased across most countries until mid of 1970s, and start to increase. At the same period, actually, the income inequality, trade unions increase until the same period start decreasing. So probably that means society, because the inequality decreased too much, they have less attention to the inequality, and that's represented by change in the trade unions activity, which start decreasing in the same period. The problem with trade unions is probably, as literature suggests, could be a good measure for the society reaction for the income inequality, but it's not directly measure the social value. Our second measure, it's actually, we use Google Ngram viewers. We use some words, and we see how often people talk about these words, because according to some paper published in some psychological journals, they discuss that when people talk about more issue, because this is actually represent more concern about society about this issue. Indeed, we select two words, the word poor and word income. We try to avoid complicated concepts like, for example, Gini index, because it's very difficult. We talk about to ensure that we have enough frequency. So we select simple words which we believe is represent or reflect the social value. For example, word poor. When we talk more about poor, that means we have a more concern, we give more attention about income distribution. So it is matter, the income inequality, it's very high. We have a more attention to income inequality, so we talk more about poor. Income is the opposite, actually. Income is like represent individualistic cultural value, okay? So when we talk about more about income, we have a less concern, it represents less concern of society about income inequality. So this is the two words, we'll use them as well in addition to the trade unions as a proxy for cultural, for social value. Before I show you the relationship, how the relationship between poor and income look like with income inequality, I want just to show you why using any gram viewer makes sense, is meaningful actually. So if you see this graph, for example, for the United States, this graph here show you how often people talk about the trade unions. So this is the frequency of trade unions, and this line here is union density, is the actual data. And as you can see, they are very close. So these provide like reasonable evidence, we believe, about using word frequency is meaningful actually, and it's reflect the concern of society. If you see this graph, again, this graph shows you the relationship between income inequality and this two word frequency. You can see that income inequality again is decreased until 1970. During this period, we have a less concern. Maybe you don't see enough fluctuation here in the poor word frequency. This is a poor, and this is income frequency. As you can see, poor decrease is the same direction. So we have a positive association with income inequality. Why? Because we believe when the income inequality decrease, we have a less concern, as we mentioned, it's positive relationship. You have a less concern about income inequality, so that people talk less about poverty or about poor, sorry. The opposite with word income, as we can see, it is positive, negative correlation or negative relationship. So when inequality decrease, the word income increase. The correlation between this series and this measures for both is something like 0.6, something like that. Sorry, 0.8. So this is our data. So let me move to methodology. And methodology, I will try to skip some technical slides here. What we will do in our first question is to investigate the rebound hypothesis. So we want to investigate the trend for Gini index, and of course the same for top 10 income share. So we'll estimate the trend using either this model, which is TS model, trend stationary model, or DS, which is a different stationary model. So if we find the unit roots, we're using unit roots, of course, we can decide which model we should estimate. This actually model approach is very common and used a lot in the study which use the trend of commodity prices. So we will, if we have, if the index actually for specific country is stationary, in that case, we can investigate this model. And of course, we'll investigate, we'll use unit root which allow for 1 and 2 breaks. So maybe we'll estimate not only 1 slope, we will estimate 2 slope or 3 slope, depends on the unit root result, okay? And of course, the unit root will show us a break, and in that case, that's allow us to investigate the rebound hypothesis, okay? So if we find a break around 1970, 1980s, that's supporting Piketty conclusion or hypothesis, and then we can estimate the trend before and after the break and see if we have a significant trend. We allow only for 2 breaks maximum, because if we have more breaks, in that case, we'll have a few number of observation before and after the breaks. This is not enough, especially we talk about time series, not panel. We want to investigate for each country individually. So if we allow, for example, for 5 break, maybe we'll end with some like 5 or 10 observation between 2 breaks, which is not enough to give significant result, okay? So we allow only for 2 breaks. And in addition, 2 breaks is actually consistent with Piketty story. He suggests we have a break around World War I and World War II. This is the first break, and the second break around 1970. So we believe 2 break is enough actually and reasonable to investigate the inequality trend. The same for DS model also. With DS model, we investigated, this is the slope, of course, this is the different stationary. If we cannot reject the unit root after allowing for 1 break or 2 break, we investigate the slope. We test the slope by estimating this equation. And even in this case, actually, we allow for break. We use Byron test in 1997 to see if we have a break. So even when we estimate DS model, we allow for 2 breaks to see if we can also observe.
Yousef, 3 minutes,
yes,
please. 3 minutes.
Okay, I gave more attention to the methodology and introduction. So the methodology also to investigate the relationship between social value, between the social value and income inequality measures. We use both Bayer-Hanks combined configuration test, and we use also Gregory enhanced 1996 configuration test, which allow for break. And if we find a long-run relationship based on this configuration tests, we investigate the relationship to see the sign of the impact of unions and word frequency on income inequality. We use error correction model. So let me discuss the result very quickly. Our result actually, we find homogeneous negative trend across most developed countries using both measure until 1970. Actually, this is consistent with the literature. After the break, the trend is more heterogeneous. We find sometimes it's significant, and this is also consistent with the literature. As I told, this is not a new evidence, but it's a new technique, and I think this is important contribution for the current literature. But our overall index showed the break around 1970 for most countries, which is supporting the rebound hypothesis suggested by Piketty. Our second point is about we find a co-integration actually between inequality measures, trade unions, and word frequency, the frequency of word income and the frequency of word poor. On the other hand, we find co-integration. And let me just show you very quickly the result from co-integration evidence. So as you can see, the co-integration between Gini and income, Gini and poor frequency, Gini and unions, and top 10 income frequency, blah, blah, blah. So as you can see, we have a significant evidence for co-integration. Moving to the sign of the impact, actually, we find the word poor and income, they have an impact, significant impact using error correction model. We find unions, first of all, unions actually reduce both Gini index and top 10 income share. In addition, unions actually reduce, union has a negative impact on word income and positive impact on word poor. What does mean? That means when we have a more, when union combat the inequality, that means the inequality decrease and also the concern of people about inequality decrease. So the frequency of word poor will decrease as well. And this explains the positive association between inequality and word poor. On the other hand, when the inequality decrease as well, the frequency of using word income increase because we have a less concern about inequality. So we have a more individualistic discussion. We have more discussion about word like income. So the concern about society, about inequality will decrease. And that's what we reflect, this is what we can see from the frequency of using word poor and word income. So this is the result of error correction model. And the conclusion, I don't want to repeat, is the same point. Actually, overall, we're supporting the rebound hypothesis using this long run data, large sample, and we find the social value actually can explain this rebound hypothesis for our sample. Thank you very much for your listening.
Thank you very much. So let's applaud all speakers, please.
Thank you very much.
Yes, excellent talks. Now let's go to the questions. I have already noted some questions here in the chat window, but let me ask if there are immediate reactions, for instance, to the talks. So we are just, well, 30 persons, perhaps. You can just speak up. Just if you have a question, just switch on your mic and speak up, I would say. So if I may ask a question to Yousef.
Yes, please.
I'm a bit skeptic about to use unions as proxy for perceptions of inequality. Isn't that problematic simply because of the role of unions have changed because industry structure has changed, right? I mean, in Germany, for instance, unions used to play a big role in political discussions and in the formation of public opinions about many things, but they do so to a lesser extent now, just because I think the structure of industries is changing. But that does not mean that inequality is not a huge issue still in Germany, but it's not so much promoted by unions, but by other institutions.
Indeed, I totally agree with you because we know that we have a many motivation for people to join trade unions. It's not only, and there are other factors, of course, affecting you, not only the view of society, as you mentioned. Also, since 1970, we have a more discussion about free labor market, reducing the labor restriction, all this factor, we totally agree with that. And this is why we don't say this is like a perfect proxy for the view of society, but we believe it's one of the main factors. I don't know if you agree with me. It can be one of the main factors that actually can enhance people because based on the literature, to enhance people to talk, to fight the wage disparity and looking for more equal distribution. This, and of course, maybe you can see all the time in France, for example, when people strike all the time for better distribution. And by the way, in France, they have very strong labor unions actually, and just all the time they fight because they don't believe the wage is fair. But I totally agree with you, and this is why actually we support our story with the second measure of income, which is the frequency of words, using the frequency of word poor and word income. Based on some study, they show when people talk more about specific issue, that's mean because they believe it's really matter.
Very good. More questions also to the other speakers, perhaps.
There are some questions to Sovik in the chat. If Sovik would just...
Yes.
Yes. Can I respond?
Yes, please.
Yes. To the first question that was asked by Professor Sommer, sir, I would like to point out, you have very correctly, your question very correctly kind of hits at the fact. In the literature, what people do, they break up these indicators. If you go by the World Bank indicators of different fiscal decentralization indicators, those are independent indicators. Now, what we wanted to do was, we punched in 3, 4, and giving them equal weights, we wanted to see that how these indices change for a particular country. Let's say for India's case, or you can do it for any other case, giving equal weights, and then you formulate an Euclidean distance that from the maximum measure, what is the extent of deviation, and you have the extent of fiscal decentralization. That's why I kind of call it a modified fiscal decentralization index rather than calling it the standard fiscal decentralization.
There was also a second question to you, Sovik.
Oh, I'll just check.
Yeah.
Oh, sorry, you had asked. Sorry, I
yes. That's why I remember that's why I remember the question. So the question is really, China and India seem to be so different in terms of economic arrangement and institutions, so that when you say that India is more sensitive to fiscal decentralization, then we really don't know why is that so, right? I mean, there are so many factors that are different. Can you say something more specifically why you believe that in India you see other effects to fiscal decentralization than in China?
China. Sir, I like to point out, and it's indeed a very good question. So this basically targets the motivation of the paper. While I started talking about the paper, I was focusing on one thing. That was both the countries are kind of, there is the scale of heterogeneity in terms of political angle, cultural angle, you bring in maybe the demographic angle, everything is different, but they are similar in terms of the economic, I'm not talking about the economic arrangement in terms of the political setup, but in terms of the economic performance, maybe the growth rate, the way reforms were initiated, that was very similar. Now, it did not follow a Big Bang approach, but rather it was sequential, and while it started in India 1991 onwards, when we had the great liberalization, but in China it started in the late 80s, in fact mid 80s, but the way it was done, that was similar. And growth rates, though China is overpowering India at this point of time in terms of the growth rate, but they are almost on a similar track. Now, given this, why I wanted to analyze, and you can have a comparison between any two countries, but coming to your second question, I'll just read it carefully once. Yes.
Thank you.
So the second part of the question, sir, I wanted to answer that while we get to see these differences in so many aspects, in terms of so many aspects, we believe that there might be a reason that these social tension in China, the amount of social tension is not that much. So it can be one of the reasons. The level of the share of urban population in India, that's very different from China. That can have an effect. Trade is more or less similar. We don't have a contest on our hands on that front. But the main focus is not only inequality and poverty per se, but this ethnic, religious diversity, the polarization. I think that matters. And I ended my paper with a word of caution that the size of the government, how the government is trying to pump in money for these social welfare schemes. I think these 3-4 arguments will justify to a certain extent why these results are there, but definitely needs refinement. Thank you so much, sir, for asking the question.
So thank you so much. There are more questions now in the chat window, but I think I would like now to give back my chair duties to the big bosses here, Tatiana and Dima, because I think the keynote lecture is soon to come. And so I should stop here and ask Tatiana and or Dima if you allow more questions or whether we should stop now here.
I would like all participants from Stream A to go through the questions in the chat. If you have more questions, you can still supply them in the chat. There will be a record of the session, and there will be contacts of all the participants, and you'll have the chance to answer the questions and talk more. I would give the floor to Dmitry to introduce our keynote presenter today.
Hello again to everyone. I saw Michael's name somewhere on the list. I don't see him right now, but Michael, are you here?
Yes, I am.
Yes, now I can see you as well. So good to see you. Hello. I know that you've been traveling. It's a great pleasure for me to introduce Michael to everyone in this conference. When we first met, Michael was a very tough theorist working on finance, hardcore financial econometrics, and there was a paper in Review of Financial Studies forthcoming at that time. I think since then, he has expanded into many other areas, working also in the areas of business. He has taken over other positions. He has gone through a number of universities, but I think for a long time already he is at IWH, the Economic Institute in Halle in Germany, also affiliated with other universities. I mentioned IWH just because he is a director of Department of Financial Markets, if I remember well, and I had a pleasure of coming across a number of PhD students coming from that department, high quality PhD students applying at universities. And it's always a pleasure to see those students also at the conferences. So it's a very high level institution in Germany, led by Michael. Michael has extensively published, as I mentioned. I mentioned RFS, Review of Financial Studies. I think that there is another publication forthcoming in RFS right now, maybe related to the topic of the today's talk. There are publications in Journal of Monetary Economics, Review of Finance, Journal of Financial Intermediation, Journal of Business and Economic Statistics, many top journals in applied areas of finance and business. And also Michael is leading a couple of journals, a Journal of Economics of Transition, and I think very recently is taking over the role of the editor of Journal of Business. So the profile of this person matches the profile of these conferences to 99%, if we leave 1% just for stochastic error. And I am pleased to have Michael here. I'm pleased that he made it after his trip to this online conference. And Michael, the floor is yours.
Thank you so much, Dima. It's a great pleasure and for sure and a great honor to be invited here to talk about my research. And usually on this occasion, I thank the host for the warm words of welcome. In this case, Dima, we need to have a word entre deux afterwards for setting the bar so high, because this is really not fair. For the rest, I'm very happy to be here virtually. I hope that I will also have at some stage have a chance to join physically Perm. For now, I would like to share a few thoughts with you, which is kind of a medley of recent research. And if you don't mind, I will try to share my screen. And bear with me for a second. All right. So can you hear me and can you see my screen? Unless yes, I hear ferocious opposition, I will just continue under the assumption that you do. So what I wanted to do today is indeed trying to speak to the post-Lehman blues, since much of my research is on financial economics, and I'm interested on basically in the nexus between the financial and the real side. And I hope that I can walk you through a couple of insights that occurred to me over the last 4 or 5 years or so on what we did in order to combat the great financial crisis as a first aid, if you wish, what might have been structural causes and what essentially is left to be done now in light of a new or the next crisis, namely the COVID pandemic. So I realize I have 45 minutes, so I will get into the meat right away. The setup is as follows. The setup of this talk that I thought up was 3 stages. First, I would like to walk you through evidence on some of the major responses that the great financial crisis sparked, specifically an assessment of a very detailed, unconventional monetary policy and what this did do to financial firms' responses, including all the concerns that are frequently voiced in the press. Then I would like to talk about what, according to my very personal view, now that's the big advantage of giving a keynote, I face a little bit less opposition from a fierce discussant, but can just bloat out an opinion as well. So I would like to share with you some of my views on what could be fundamental causes for problems arising from the financial system that eventually land on the feet of non-financial firms, i.e. the real sector businesses. And in the end, I would like to share with you some latest insights from policy work. So not super rigorous, but still interesting, I think, based on the resilience of the financial system some 10 years or so after the great financial crisis, so as to combat, as I said, the real shock of the COVID crisis. The talk is based on primarily empirical evidence from research and less so from policy projects. And it hinges for a large part on microprudential information for German banks. So what I tried to do, and I thought about this for quite some time, let's see if I succeeded. I aim to strike a balance between, on the one hand, scientific rigor and identification of causal effects in an empirical sense, and external validity, so as to speak to broader implications. And let's see how we go along with this. As mentioned throughout, feel free to send questions into the chat. And if there's an urgent question, I'm also not upset or annoyed if you ask a question just into this session. I don't mind at all, in fact. So let me start with what I call responses. The first aid towards the great financial crisis, the demise of Lehman, but also Bear Stearns and other banks that came into distress after the housing bubble burst, was essentially the conventional toolkit of central banks. So what you see is this steep decline in policy rates, and essentially by the time that Lehman exited from this world, we, within a very short amount of time, went to the zero lower bound, and not only in the United States, but essentially across the globe. And I just show you here 3 central banks, but this is pretty standard for all developed and developing nations. Now, I think what is the important takeaway is that shortly after Lehman went bust, we hit the zero lower bound, thereby foregoing the conventional monetary policy tools at the zero lower bound. And as a consequence, many central planners came up with quite ingenious ways trying to, stimulate the economy and reinstate a functional transmission mechanism of monetary policy. And most of this was related to quantitative methods, essentially, on the one hand, easing access to liquidity for banks, on the other hand, purchasing assets so as to provide alleviation of equity pressure of financial firms' balance sheets. What I'm going to show you is some micro evidence on the very first asset purchase program in the Eurozone, which by today's standards, 12 years after Lehman, seems minuscule, but has the great advantage of basically being the first timer of this new normal, and as such bears potentially some implications towards causal identification. Now, what happened at the time is that the ECB more or less in an overnight action decided to purchase around 200 billions of stressed sovereign bonds. And that was not in response to Lehman, but that was in response to the sovereign debt crisis in 2010. It was, however, necessary because of Lehman, the conventional monetary toolkit was no longer available at the ZLB. And you might think that this, of course, is Mickey Mouse in comparison to QE 1 till 3 in the United States. Yet, these volumes post something like 3% of GDP that were majorly purchased in 2 tranches, sort of from any bank who had these securities. This is the shock that I'm going to use to try to find a micro evidence trail of how these unconventional crisis combat policies panned out. Because in fact, what might have been a great idea at the time could backfire. And when the policy was launched in 2010, was clearly cast as something necessary to do so as to reinstate functioning monetary transmission. But it occurred even to Mario Draghi himself just half a decade later that, well, okay, if you throw sort of undifferentiated money at the economy, there might be all sorts of side problems and side effects that you might have to swallow. And understanding these different consequences of these new conventional policy tools is sort of the center stage of research, I would say, in the first half decade right after Lehman fell. And this is one piece of this research. And it is important because unconventional monetary policy, think of the PEP recently in combating COVID, has potentially huge negative implications. There might be liquidity hoarding by banks. They might not pass on, but rather sit on the liquidity. There might be incentives for banks to take this cheap extra money and pass it on to exactly those businesses that they never would have lent to begin with before this subsidizing monetary policy. There might be regulatory arbitrage and carry trade, which is, hidden deep down in the institutional details of these various purchase programs. Think of cost benefits to the refinancing of banks conditional on to whom they lend in targeted lending programs. More generally, there's the concern, and especially in Germany, this is a very prevalent concern, or let's say Northern European countries, that by helping out stressed economies such as the southern periphery in Europe and Ireland at the time, you basically sow the seeds of fiscal lack of discipline and thereby subsequently financial instability. What this paper is doing here, on which I base my next slides, is that we would like to know if banks that were exposed to this rescue project of the ECB geared towards the southern periphery of Europe, if German banks exposed randomly to this shock did all of these bad things, like, start risky lending and do all sorts of crazy stuff, thereby shedding light not only on the effectiveness, but also on the potential unintended side effects of such a policy that has become the new normal after Lehman fell. The takeaways is essentially that there's no real concern for Armageddon. So this research here will show you that those people very concerned about this is the end of the world as we know it by providing a liquidity through asset purchase program are not confirmed. Instead, we see that commercial lending increases, whereas mortgage lending, which you could consider unproductive, contracts. Let me show you how we find this. The identification idea of this whole paper hinges on the fact that there might be undesirable consequences of providing certain asset purchases to a selected group of banks. So in fact, it amounts to a subsidy of those happy few who hold an Italian or a Greek bond that the ECB decided to purchase in an emergency response. And this might cause down the road a comparative disadvantage towards non-supported banks and then subsequently maybe to the corporate customers of these banks. As such, it is really an old story, and more formally, Hendrik Hakenes and Isabel Schnabel, Isabel at the time still a professor and not the ECB member, show that there are funding subsidies embedded in these type of implicit guarantees or explicit asset purchase programs, which may crowd out non-protected peers' activities. Now, the idea here is that we're going to track at a very detailed level. We follow the money, so to speak, how these purchases of individual securities by the ECB affect a certain subset of German banks and how this subset of banks responds and behaves differently vis-a-vis those banks that did not hold treated securities. Now, we do not believe, of course, that the ECB launched the SMP to support local German banks. Mario Draghi's concern about the savings bank Pusemuckel, or in the middle of nowhere county, was probably going towards zero. He was probably concerned about the general stability of the euro. Now, this is making for great identification because it's most likely a truly exogenous monetary policy shock towards German banks. This might not be true for Italian banks, a system which had been at jeopardy, but for German banking system, this shock was exogenous, we argue. Is it reasonable that banks held a French or an Italian bond at random? Well, clearly a German savings bank, think of a bank on the size of 1 billion, 1.5 billion, is not holding any security completely randomly, but the regulatory treatment of sovereign debt was zero risk weights, hence zero capital cost, which is why many small and non-sophisticated banks held sovereign debt kind of indifferently for liquidity storage purposes. So I wouldn't argue that it is a completely randomized experiment, of course not. But this is getting pretty close to having something at that time of the policy change that is quasi-random. The price to pay for this beautiful identification is that we cannot say very much about the effect of APPs on, say, Italy at the time, which is a totally different ballgame, or we cannot extend insights readily towards, say, what will the PEP do to French firms nowadays. So we gain clean identification, but we pay a price of external validity. What do we do? Now, this paper to a large extent is a data battle. We obtained from the ECB, by now I think it is 7 years ago, the detailed purchase schedule at the ISIN level, which securities they bought, which we then combined to Bundesbank, so the German central bank's security holding statistics data, which contains information about the ISIN number of each security that each bank in the system is holding. So I see essentially which bank held prior to the launch of the policy change a security that was bought by the ECB, thereby giving rise to some banks being, so to speak, subsidized if we believe that the additional demand by ECB made it more favorable to hold security A, versus banks, in this case B, that did not hold such securities. Eventually, we then connect these banks to firms, but that is something I won't have time to get into. Now, the identification to wrap up here is therefore hinging on the fact that we have a quasi-experimental monetary policy shock, which affects some banks, and we compare essentially these treated and non-treated banks. This is all we are doing. The nice thing is that we can therefore rely on pretty standard techniques. There's methodologically really no hand-waving or innovation here. You want to explain the landing of bank I in quarter Q as a function of some controls, loads of controls for unobserved fixed effects, so fixed effects per bank, but also region times quarter fixed effects to absorb regional business cycles. And then what you're really interested in is there any differential development in lending for those banks that held an S&P security compared prior to after the shock has happened? And what we do is we have this beautiful quarterly lending data at granular levels for the entire population of German banking. So this is not a subsample of large banks or of banks being active in the syndicated loan market. Essentially, this is the system as a whole, which is why I believe that such a study might be informative also from, say, a more macro-ish perspective. We compare the 5 years quarterly data prior to the S&P to the 5 years after the S&P has been launched. And as I said, we saturate the model with a rich set of fixed effects, thereby allowing us to be fairly agnostic about any business cycle differences, for example. Now, does it matter? I don't know if you realize, but this is quite a granular and unusual setting. You really see at the security level which bank has been holding which security, and you know from the central bank at which price, which quantity of which Greek sovereign bond exactly was bought when from whom. But you might, of course, argue or suspect that why should a German local small bank, on God's name, hold an Irish govie? That is far-fetched. Now, this concern of ours when we started the project was quickly pushed aside. So what you see is that, and this is not Deutsche Bank and Commerzbank, this is just the number of local banks in Germany, of which there are many. You see it, it's something like 1,500, 1,600 banks. And during the periods of the S&P program being active, you see that around a sixth steadily held some security from the southern periphery. So this is not a story about some crazy Landesbank or some crazy large multinational bank like Deutsche Commerzbank, what have you, not speculating on something. This is sort of shown by Viral Acharya and co-authors that this is going on. This is a story about you know, even those banks that are holding just for liquidity management purposes, sovereign debt from the Eurozone, they will be exposed to one form or another of a monetary policy shock. At the same time, this 1/6 of the system that is exposed holds very low values of Greek, Irish, Spanish, Italian, and similar sovereign debt, as can be expected. The median holdings in market value of the total portfolio of securities of these banks is on the order of 1 to 1.5 percentage points. So you might think like, okay, maybe there's a differential effect, maybe there's a shock you can identify statistically. But why should this matter for economic policy? The point is that only very few banks, probably of this kind, exchange outright these securities. This is not, you know, Wall Street and speculative bankers who really want to make a quick win. These are very low-key SME catering provincial banks. But even if they hold on to their stuff, there is a valuation effect, because if the additional demand for these S&P assets, and if there's a true commitment of the central planner who says, look, whatever it takes, we're going to stand ready to buy up that stuff. If this is perceived by markets to be credible, the valuation of these and associated assets will go up. And guess what? When we looked at the balance sheets and the security holdings of all German banks, this is what we found. What we found is that the volume of these Greek, Italian, Irish, Portuguese, and Spanish sovereign bonds in the portfolios of savings and cooperative banks is not super large, but well, still 40 billion. What matters much more is their total exposure to these countries' corporate and sovereign debt that was not purchased by the ECB was much larger. So we are talking about 250 billion on the aggregate balance sheets of German small banks in terms of exposure to these stressed economies. And to put these numbers into perspective, the total system had a size of some 6,000 billion euros. So having a share of 250 billion is a significant share when it comes to equity relief. And the central bank is basically subsidizing, in general, Greek fixed income. When you then compare just the lending patterns of these regional banks with and without S&P, and this is, you know, just eyeballing, what you do see is that there seems to be a steeper trend in lending for those guys who have been happy enough to quasi-randomly hold an Italian bond, whereas these growth rates did not seem to, you know, tilt upwards so steeply after the start of the first quantitative easing program in the Eurozone. Now, this is what we then go on and test slightly more formally with regression analyses that you are certainly well acquainted with. So let me just walk you through these regressions that I showed you in the previous equation that mimic this graphical evidence. So first, we just run a very simple ordinary least squares to explain the log level of lending of bank I in quarter Q as a function of, was it a bank that at any stage of the S&P program held a security? Compare their lending prior to the program to its lending after the program, post, and then see if there's a differential effect between these two effects, the interaction term. Now, in this specification, we do behave extremely ignorant. We don't care about a bank in Berlin being fundamentally different than a bank in Munich or a bank in the middle of nowhere. We do not account for unobservable traits of the bank at the time of the shock, and so forth and so forth. We don't even account for seasonality and cyclicality at all. And still we find that in general, there's a positive increase in lending after the central bank signaled to the market, look, we know we're at the ZLB, we know there's a problem, we're gonna switch gear and we're gonna start buying up securities. This is by all means not causal. This is just correlation. But this correlation is indicating that on average, the average bank expanded lending after the first signaling of we're going to go APP by 32 million. And that corresponds to an aggregate effect for all 1,800 banks to approximately 57 billion. And this is large, by all means. Now, as we move on then through the table, we gradually saturate the model with more and more fixed effects, thereby taking care of all sorts of unobserved heterogeneity in the data that could, also drive lending choices. And at the end of the day, what we do is, I would like you to focus on this column here. We just look at the 5 years before and the 5 years after the SMP, and we leave out essentially the treatment period itself, accounting for business cycles at the county level and controlling for observable bank characteristics. And what you see is here this effect of 0.005, which is statistically significant at the 1% level. And that corresponds to essentially each bank in Germany, because of the SMP, increased lending by almost 3 million on average. And bearing in mind that these are very small banks, and bearing in mind that this is a differential effect, it is also quite remarkable that a program that was supposed to rescue Italy and Greece had beneficial effects also in Germany. Let me skip this in the interest of time. Now, the dark side of these rescues could be that you throw liquidity at the economy, and many observers are very concerned with such side effects today as well. But you might get reckless lending. You might get banks who no longer do their screening properly. So what we do is we first going to look at, is there excessive lending in the sense of having growth rates that go through the roof? But neither Q-on-Q growth rates for commercial lending or retail lending respond significantly. We then look at whether there's, say, competition capture. Those guys who happen to be treated better by the policy conquer market share and crowd out those untreated ones. And there's some mild evidence indeed that those banks that are more exposed to the policy also gain larger market shares, at least for the productive commercial loans. What I find most important here is, however, something else. What I find most important is this policy of a very Bugakova type of monetary policy, the lender of last resort, the guy who's doing whatever it takes, leads to higher liquidity levels with banks, which should increase resiliency of the system, and it increases profitability. Whereas it does not increase credit risk, at least in an observable kind. So these are really good news, leading me to conclude from this perspective that there are few signs of Armageddon of unconventional monetary policy. Lending is stimulated in general. The differential effect is economically substantial. So the 2.8 million translate into, in total, almost $1 billion of additional lending. And most of this lending occurs through commercial credit, which goes to firms, rather than real estate lending, which you might argue could have fueled a bubble. So it seems that bank resilience has benefited from these first 8 measures right after Lehman at the zero lower bound. The question is, how sustainable are such emergency actions? When the roof is on fire, you need to do something, and it seems that they did pretty well. But it doesn't go to the root of the problem that you have a banking system that might be unstable. And that eventually might say something about how firms have to live with consequences of future crises. And this is what the next set of results is about that I would like to share with you. The next set of results is more to what I consider at least some of the main cause why we do see that the financial system becomes increasingly a potential reason for concern. And I argue that actually it is market structure that is a main challenge to stable banking these days. And I think this is globally true, probably more so for Germany and Europe than for, say, the United States and Asia. But in principle, the European Systemic Risk Board already attested in June 2014 that this patient is abnormally heavy, basically a very, colorful language for saying that there are too many banks. And this was basically Martin Hellwig pushing this a lot. But he wasn't alone, because also Vittor Constancio, at the time vice president of the ECB, second man in charge with Mario Draghi, shared these views. And 2 years later, at a speech, he, for instance, continued to lament about low profitability and overcapacity being a problem as you go along with financial stability concerns and ineffectiveness of monetary policy. The European Banking Association is confirming this, and the reason why poor profitability is a structural concern is simply that you cannot retain earnings and build up equity buffers that are needed to combat large sudden shocks, such as the one that we are facing right now. The trouble is that in normal industries, whatever is normal, we wouldn't have to be concerned with these mechanisms and dynamics, because we would only need a recession to eliminate the slack. And this is well known in textbook economics. A market exit of a Schumpeterian kind would take care of eliminating unproductive units in the economy in general and in an unproductive sector in particular. And usually it is even the threat of hostile takeovers that would suffice to make managers run faster or close down business. The problem is, in EU banking, we have a very limited role for market discipline. There is no such thing like corporate raiders that could buy up equity, fire half of the personnel, and liquidate the unproductive factories. Why? Because very few European banks are traded. There's no free floating market of equity. And most of these sectors are kind of national champions closely attached to politics. And that holds not only for developing nations, it also holds for economies like Germany with very high levels of corporate governance and judicial and other systems that ensure that there are checks and balances. But still, there's no market discipline of a textbook kind. And that is reflected by notoriously low consolidation activity. And that in turn, I think and argue, is part of the problem why we have sustained poor profitability since Lehman, which will pose a problem nowadays. So what I'm showing you in this little exercise for 8 minutes coming up is evidence on the fact that it is really political frictions that pose a potential impediment to banking market consolidation, which is in the way of having a sustainable level of profitability. And that is important because there's just so much monetary policy can do. The first 8 I showed you before will eventually hit the wall as well. And we need structural reforms in the financial industry as well. So what we do and find in this paper is the following idea. Again, this is sort of the attempt to take scientific evidence to policy advice. There are 2 different types of banks in Germany. Savings banks, which are owned by their local politicians, counties, and cooperative banks. These banks are very comparable regarding business model, size, clientele. They basically cater to small and medium enterprises. The difference is that a local savings bank is required by law to merge when their owners are merged, i.e. the counties in which they are residing. The issue is that it is federal politicians at the state level which vote on whether or not to reform counties. Usually you reduce the number of counties, which in turn enforce consolidation on the local politicians, i.e. the mayor who wants to have a bank of his own to, conduct economic policy. And this friction between different levels of politics is what we exploit for identification of causal effects, because you can imagine it's very hard to say anything about the effect, the causal effect of a merger on profitability, since pre-merger profitability likely is driving the reasons whether or not to merge to begin with. So you get normally circular reasoning. Now, what we do is we identify the effect of these forced market exits. Why? Because we argue that the local bankers have no influence and also play no role for the decision of state parliaments on whether or not to combine counties. And then we compare, you know, returns of banks that have been in counties that have been reformed, but that haven't been exposed to the policy, and see if there's a difference. The takeaway is that return on equity for those banks involved in a merger forced upon them is significantly and substantially higher for up to 4 post-merger years. And this is what I call very humbly the killer chart. So this is in event time. This is the time of a merger for a group of savings banks, only savings banks, same, that are residing in a county that has been put together. So there's no choice. They were forced to merge together. So this is where the political impediment has been eradicated by the next higher level of political decision-making. And compare that to mergers of also savings banks. So they have the same governance, same objective function, you know, all of this is very comparable. But this is a merger of 2 savings banks that voluntarily decided to go together. And you see that there's a huge differential effect in return on equity, somewhere on the order of almost 2 percentage points in the first period. And given the very low level of return on equity, this, you can imagine, is huge. The counterfactual would be to look at banks where the government has nothing to say, where there is no room for political economy, where in a way, you know, it shouldn't matter whether you have 1, 2, 10 counties or 1, 10, 2, 3, 5 politicians sitting in the decision-making process. And these would be cooperative banks. And here we compare cooperative banks in sad counties that have been unified and compare it to cooperative bank mergers which are located in counties that haven't been reformed, and there's no significant difference. So the mergers might be doing something, but it has nothing to do with the cutting of the political impediment. I have to speed up in time a little bit, so let me skip this and illustrate the identification only with maps. This is Germany. And we start with the sample some 4 years after unification. So in 1993, you had 542 counties. And say you have had a bank here and a bank here. And in these 2 counties, each county or each mayor owned, so to speak, its own savings bank. As time progressed, people realized that there were way too many administrative units and you cut back on them. And this was decided at the level of the state. So in this case, Mecklenburg, Western Pomerania. It was not the county heads of these formerly 2 counties who decided to join. It was the guy, in this case in Schwerin, who decided you have to go together, which was an exogenous shock for these 2 guys. And as we go along, turned out that even those markets were still too small given economic activity. And you had this ongoing consolidation of counties leading to 402 counties eventually in 2008, which makes for quite a fair number of exogenously forced mergers. You see, the reduction of counties was predominantly happening in the east of Germany. Around 50 to 60% of counties were reduced away. And this is commensurate with a sufficiently large number of both savings banks, which are affected by the political friction, and cooperative banks, which are the control group. And what you see is that they went in lockstep with this consolidation, but facing exogenous shocks. So the comparison is going to be, imagine you have 2 regions, K'1 and K'2. And you have 2 savings banks in these 2 regions in Western Pomerania. Now, we know that eventually they're going to be residing in 1 region. And therefore, these 2 savings banks will have to be forced to merge. So what we do is we create a synthetic bank from supervisory data at Bundesbank. and we compare this synthetic bank post-merger to pre-merger relative to cooperative banks, which also have been merging, but these guys did so voluntarily because there was no legal requirement to do so. They could have decided to stay alone, like this cooperative bank number 5 did. So we compare this forced merger to voluntary mergers, and we compare this forced merger to non-mergers. And if it is true that it is the killing of the political barrier that releases profitability potential, we should see a positive differential effect. This positive differential effect would be in a difference in difference equation, the triple interaction between merging in a reformed county and being a savings bank. We control for all sorts of unobservables. It's pretty much a similar methodology as in the previous exercise, so I'm gonna skip it here, and I'm gonna jump right to results. And I'm gonna just show you the headline results in the interest of time, where we compare first only banks that have been merging in reformed counties, only 2,400 observations. Any merging bank, also in West Germany, where there haven't been any county reforms and thus no political changes, and eventually compared to any bank. So we basically inflate the control group, which should work against us in terms of economic and econometrics precision of estimates. The catch is that no matter what you do, you find this, you find this triple interaction effect to be highly significant and large. Essentially, if you look at this effect here, despite the reducing or mitigating effects from reforms and mergers of savings banks, you see that it is really this triple interaction of not only being government owned, but facing a reduction of political barriers and being part of a merger that really releases profitability potential. The reforms themselves also have a positive effect. So reforms themselves increase return on equity by 3.3 percentage points, which is almost half of average pre-merger return on equity. So this is huge. If you hold here for a second and think about not only German counties, because you might argue who cares about savings banks in German counties, and think instead of Europe, I look at this as something where I believe that at the moment we would like to have 27 plus countries, all of which want to have a national champion in banking, but probably there's not enough space for that. And probably we have a lot of political barriers between countries, very much like the ones we see here at the sub-federal level, that are exactly the same logic. You don't want Deutsche Bank being taken over by a Dutch bank for political reasons. And this here is, to me at least, indirect evidence that, you know, getting rid of these political impediments probably has the potential to release quite a bit of profitability potential, which in turn is helping financial stability because it allows you to build up buffers and be more resilient when facing a shock. If I look at the time correctly, I have some small 4 minutes left. So I would leave the analysis here as far as the forced mergers are concerned and just give you the conclusions, because I would like to spend 3 minutes on my final building block. This whole analysis shows that the killing of political impediments has a significant profitability effect in an otherwise very underperforming banking system, namely Germany. I didn't show you the evidence, but there are results that it is also firms that benefit from this. The customers of these, the corporate customers borrowing from banks that have been forced to merge have lower refunding costs, invest more, and at the same time are not force-fed additional debt. So this is a very positive story for banking and the real sector. This increase in return on equity is coming along with slightly more risk. And an important limitation is, of course, that this is partial equilibrium reduced form. I cannot tell you if it is good or bad that more ROE comes with more NPL, because this is hard to say, as I said, in reduced form. My personal hunch is that at the moment we see, if anything, too many banks that haven't had enough profitable opportunities to seek, and this is the main problem. So I would plea very much for European consolidation, which should, at acceptable levels of risk, enhance profitability. And this is important because it speaks to the resilience of the system. And 12 years after Lehman, we are now in times of a new shock. Dima, please give me a red card. If I go way over time, I need 3.5 more minutes.
You have 4 or 5 minutes if you want.
Thanks. So I try to figure out and sketch the road that first aid is good. It helps to, given a banking system, helps to put out the roof that is on fire. But you need structural reforms to tackle excess capacities, obesity in banking, if you want to use Hartin Helwig's figurative speech. And this is important because today we have a new crisis, COVID. And one might wonder if the great financial crisis left the financial system crippled to deal with this shock. What we do is we take a stance on the fact that COVID is a real economic activity shock, which is very different from the financial shock in 2007, 2008. Here, the first round effect is on SME. This is not big international powerhouses on financial asset markets. This is credit portfolios of small banks being exposed to SME. And our first line of defense has been, at least in Germany, but I think in Europe as well, to have massive fiscal support to both firms and workers. So why should I care about banks? I want to care about banks because these fiscal support measures, to be clear, around 1 billion euros in Germany, only will make it to workers and households if you have a financial system that is able to channel it. And clearly, this will speak also to a situation where you have an increasingly reduced fiscal capacity of governments to act as a backstop as we go further into the recession. So we need basically knowledge about how many stressed banks are out there that would hamper transmission of policy. The contagion channel we are considering in our stress test here is non-performing loans. And this is because more than half of these small banks' portfolios are loans and not financial assets. What we do is we're going to focus here on this second stress test. We do use sectoral GDP forecasts from the macro department of IWH, which basically say that there's a V-shaped scenario with a rebound in Q3, half the pace of recovery in Q3 and Q4, and an L-shaped recovery of the economy, i.e. a second wave and no recovery until Q1 21. And what we do is we connect many banks to many firms and just look at to which sectors did these banks lend prior to COVID. And then we just run simulations of what would happen to their non-performing loans. Turns out, if you take this L scenario, 28% of all German banks will face corporate loan portfolio stress that, under the assumption that the entire stress in credit portfolio has to be covered by equity, will mean that they are critically undercapitalized. We are talking about Germany. This is a, fiscally sound, kind of benefiting economy from the last 10 years, low interest rates. I don't want to know what these numbers look like in more stressed economies. So the banks that are at jeopardy here hold in total 600 billion euros of total loans, thereby making up the major chunk of SME lending. And even if they are not formally insolvent, it is clear that if we do have a very adverse macro scenario, these won't be the banks that are particularly keen on lending to new small and medium enterprises. Let me walk you very quickly through the analysis. What we do is We look for all banks that we can find in public resources. So it's 1,300. We lose some 400 compared to Bundesbank data. And we have only data at 2017. We look at the tier 1 capital of these banks. In fact, tier 1 is only available for some 1,100 banks out of 1,500 that exist in total. And we allocate these banks to their county based on their headquarter location. We then take firm data, so non-financial firm data, for around 400,000 small and medium enterprises, for which we have at least balance sheet information from 2017, which we can match from payment relationships data to these banks. So we have a bank firm link. And what we do is we just look at how many of these 1,100 banks have been lending to firms that are located in sectors that face really poor outlooks from a macro perspective. There's many caveats, not going to go into them here, but focus on the fact that at the moment, the problem is that we don't see NPLs because we don't see insolvencies yet. So this is really second round guessing. The reason is that institutionally, Germany postponed the legal obligation to file for insolvency during COVID. And what this means is we're going to kick the can down the road. And if you look at insolvencies over the last month, you see that barely anything happened during COVID. Okay, so let me show you just the numbers. This is the forecast for quarter 1, 2, 3, 4 of 2020. And this is what the German government bases its tax estimation on. Our simulation says, okay, fine. Let's say we have a scenario like this. Let's say we have a scenario where we just have half this growth, or let's have a scenario where we have no growth, in fact. The resulting stress that we're going to get sees certain sectors like manufacturing or retail that take it really hard, and some others which even benefit. And now it depends on which banks have exposure to which industry. When we simulate the non-performing loan portfolio, what we're going to get is that even in the best case scenario, a very mild stress already gives you such a mass of non-performing loans that the average equity ratio is significantly reduced, leading to some 7 or 8 banks falling below regulatory requirements. The moment you say that you have no growth in Q3 and Q4 because of COVID, you see that there's a huge fraction of non-performing loans, all of which we assume to be covered by equity, leading to 30% of all loans held in Germany by banks that are essentially below regulatory requirements of tier 1 ratios. And this, of course, is the most dreadful scenario. And hopefully it's not true, because it might be that banks have silent reserves. It might be that they don't have to write off loans 100%. But this is basically saying that it is no longer the large banks from which the stress emanates, but it will be savings banks and cooperative banks, which in the L-shaped scenario face very large shares of stressed banks below their regulatory minimum. So on this note, I think that even in a relatively resilient banking system, bank stress seems likely to emerge. I think a very conventional channel is credit stress. And for as long as the GDP fallback from COVID is heterogeneous across sectors, you have a lack of diversified portfolios, and that will lead to financial stress that might amplify second rounds. I have some policy implications, but let me stop here and let's see if there are some questions on the talk. Thank you very much.
Thank you very much, Michael. We have 2 more minutes before the next session starts. I didn't want to stop you exactly when you were talking about the coronavirus crisis, because that's quite important for everyone. But if there is any burning question right now, we're happy to take it. Otherwise, after after the conference, you can contact Michael, or you can try to contact in chat. I cannot see. I think everyone is just very polite because because they know that the people have to move to another session. So I suggest we give an applause to our speaker. Michael, it was very interesting, really very interesting. I learned quite a lot. Thank you very much for joining us. And maybe you can join us also in person sometime next year when we have a on-campus conference, and then we can have a word entre deux.
That would be lovely. Thank you very much, and all the best to Perm and wherever else you are in the world. Thanks a lot for listening.
So I will invite everyone then to join the chosen sessions for the last remaining presentations, 4 in each session. See you there. See you very soon.
Thank you, Michael.
Hello, everyone. Do we have all of our speakers?
Dennis Coates, our moderator, is here. The first presenter,
Francisco Cabrera.
Francisco.
Yes, I'm
You're
here. Hello.
here.
Good morning.
Just wait a second. Let's see if we can give you the rights to share the slide. Okay.
I see Bernardo is here.
Hello, hi Dennis.
Yes, and Ilya, Prakhov, and Polina, Bugakova, you're here. And Cornel Nesseler, I saw him throughout. Yes.
Yes, I'm here.
Yes,
I'm
seeing
Great.
you.
All right, so why don't we go ahead and get started? We're going to begin with Francisco Cabrera. Leave Them Kids Alone, a nice reference to Pink Floyd, and can never go wrong with a Pink Floyd reference in a presentation as far as I'm concerned. So Francisco, take it away.
Thank you. So can you see my presentation without problems?
Yes.
Oh, perfect. Okay, so let me just start the presentation style. Okay, so this work, I've been working on this for now maybe 3 years, and I haven't published it, and I'm going to talk to you about a bit of the identification problems I have, and I hope I could receive some advice on that. So this project is about how failing students, and so making them not able to continue in their education, making them repeat one grade, how can that affect their likelihood of dropping out from school? So why is this important? So this is in the context of Mexico, where universal basic education, or grades 1 to 9, or sorry, there it's 1 to 9. It's really under pressure. We are one of the last in the PISA test. Our children are not doing very well on math and language and basic education, and moreover, these problems transport also to high school, where only 7 out of 10 access high school, which are grades 10 to 12. And then on top of that, 50% of those abandon high school during the first year. meaning that only 3 out of 10 people in the age of going to college or university are actually enrolled. So dropping out from school is something that is a huge problem here. Moreover, it starts early in life, and you don't need to wait until university to start observing this problem. It's something that we need to cope with that from early ages as well. So as I mentioned, in PISA, 35% of students do not reach the basic levels of reading and math and science, and only 1% reach the highest level, which is it's really low compared to the OECD average, which is around 7 to 8% in the highest level. So in some systems, grade repetition is seen as a valid corrective measure, helping a maturity and raising standards for children. But on the other hand, we have people arguing that it actually is bad for children because it reduces children's motivation, long life income, it raises family and schools costs because you have to keep children 1 extra year there at your school. And this, summing up all these, it affects pupils' dropout likelihood because they are less motivated, they are 1 year behind, they are older than the older peers, and this could affect their motivation and affect their dropout likelihood. However, these are theories. The debate is still open because there isn't much evidence, much causal evidence regarding which of these two visions are more accurate describing reality. And so these policies are broadly still used worldwide, making children repeat a grade if they don't pass some mandatory exams, or if they don't have at least a minimum standard mark, they have to repeat a grade, and this is a costly policy, moreover, also for the country. So here is, of course, there are countries towards the left in this graph which do not use or do not have big problems of grade repetition. These are Japan, Norway, Iceland. Almost no one is repeating a grade there. But then we have Mexico above the average of the OECD, where you have, on average, 15% of children have at least repeated 1 course by the age of 15. And in poorer context, which is the triangle we have here, this is twice as much, that percentage. We have other countries such as France, where they have the very strict policy, repetition policy, in which you have almost 39% of poor children repeating a grade. Sorry, this is a course by the age of 15. So this is a policy that is not only applied in developing or developed countries, it's broadly used around the world. Most likely neither automatic promotion or grade repetition solve low achievers problem. This discussion is not only based on what are the promotion rules in a school system. Of course, socioeconomic status plays an important role, and that's why it's important to observe difference of impacts and grade repetition with different across different socioeconomic backgrounds. Most of early evidence uses, however, small and self-selected samples and does not address causality. And only more recently, we have seen some evidence that that show the link between grade repetition and dropouts, but this is just correlational link. And some causal evidence shows that increasing that grade repetition actually increases dropouts, and this is happening in Uruguay. There is evidence also for Brazil, and evidence on academic achievement is mixed, because some argue that yes, if you decrease the standards and everyone can now pass the grade without any standard, they can be socially promoted to the next grade. That is going to affect performance of children. They are going to be less under pressure, and so they're going to start performing worse if you pass regulations that allow for social promotion. And so that's why some studies also verify if there is an effect of non-failing versus failing on academic achievement, and there the evidence is completely mixed. There's no clear answer to what would happen if we suddenly stop children from failing. So what do I do in this paper? I try to estimate the effects of an exogenous change in grade retention rules or grade repetition rules in Mexico on students' dropout likelihood. I do it for varying socioeconomic backgrounds and family investments to try to disclose what are some of the mechanisms interacting this with the socioeconomic background. And I also test if eliminating this threat of grade repetition has an effect on students' performance or based on some standardized tests I have for Mexico. So how do I do this? In August 2012, the Mexican government conducted a reform to the general rules of promotion. From that school year in 2012-2013, all first to third graders in both public and private schools will be automatically promoted. They are not allowed to fail anymore, and by law they could be promoted to the next year. Schools then converged from varying high levels of grade repetition to almost zero repetition rates in a short span of time. I try to exploit this law, this change, and that it's affecting all schools in Mexico. For that, I use data that comes from the annual national statistics. We have a census of all schools in Mexico that gives you this data on dropout rates, repetition rates, how many students you have in schools, how many teachers you have, about infrastructure. So this is a census data applied to schools every year. And we have this since 2016 to 2018. I merged these census information on the schools with the proportion of students receiving the Prospera scholarship. Prospera scholarship is for poor students in Mexico. So this is how I can identify the schools with a higher proportion of poorer students, and I consider those schools as the poorest. And I also use the standardized test scores. This from 2009 to 2013, we applied as well a census standardized test that evaluated all children in Mexico in math and Spanish. And I use also those tests to study the effects on students' performance. So this is more or less how this looks in terms of repetition rate. So before 2012, this is at the state level. We have 32 states in Mexico, so that's the variation we observe here. So there are states with repetition rates as high as 10%, and this is Mexico City here with repetition rates below 2%. So we have this huge variation across the country, and of course across municipalities you would also observe that variation. And suddenly in 2012, on average, this is reduced towards 1% because everyone applies this law of non-failing children and not making them repeat grades. Some states are still at a higher rate than the average, but the important thing here is that the variation is completely reduced, and now all of them converged around 1%. So this is the effect of the policy. Reducing this variation. So what I do here is that I exploit this variation we have before the treatment, before the law is implemented, and I exploit that the intensity of the policy is much higher for the states above the average before policy implementation than below the average. So I exploit that how the policy affected differentiatedly schools in different states across Mexico, and I exploit that variation. Of course, I don't have the classic differences set up when you have control groups some schools as a control group which were never treated or were staggered treated. I don't have that situation because all the schools were treated at the same time, and that's the challenge I have for my identification strategy. So what I'm going to argue or try to convince you is that the trends before policy change across states above the median and below the median change in grade repetition is going to be parallel. And that's important because in this, descriptive statistics, you can observe that repetition rates before 2012 in schools below the median change in repetition is about 2.88%. It's much lower, and it's 8.37% in those schools which were doing worse. They had different repetition rates, of course. All of them converged around 1% after the change in the law. But these schools were different, of course. These schools who were already doing better, they have more teachers per student, they have more students per school, and they were performing better in terms of mathematics and language before the change in the policy. So how intensively the policy is going to affect schools is, of course, endogenous because it depends on their characteristics before policy change.
Francisco, you have about 3 minutes.
Okay, so what I do is a two-way fixed effects model. But of course, what I have to argue here is that the trends between schools above and below the median in grade repetition are similar before policy change. I show here that the raw trends are stable before policy change, and then they change only after this law is passed. To convince you of that evidence as well, I run an event study design in which I have that nothing is going on before policy change between schools above and below the median and between schools in the first quarter or fourth quartile of grade repetition before the law was implemented. And what we observe is that only after the law is implemented, we observe this variation in dropout rates due to changes in repetition rate. So this would lead me to an average estimation of a reduction of 0.16 to 0.24 percentage points in dropout rate. So for every percentage point reduced by the policy in repetition rates translate into a reduction of 1/4 of a point in dropout rate. So allowing children to continue socially be promoted to the next grade is reducing the likelihood of dropout rates in 1/4 of a point of a percentage point. I do this for Porter and Reacher, Reacher schools. And what I find, nonetheless, is that the effect is completely explained by Reacher schools. So in poorer schools, no matter which are the promotion rules, children are not stopped to being dropping out from school. So this change in the rules is actually just having an effect in richer schools. So this is something that what it tells you is that in those backgrounds, less advantaged backgrounds, socioeconomic status is still more a predictor of dropping out rather than the school promotion rules. And then I finally test this on language test scores and mathematics test scores, and I observed that there's practically no effect. This effect is economically insignificant, is almost zero. There isn't an effect on test scores of this policy. So just to sum up, dropout rates fall around 0.17 percentage point per each 1 percentage point of reduction in grade repetition. This is a low-cost policy because you just need to change the law, and it can directly enhance, on average, school attainment. Takes more relevance if you sustain this in upper basic education, where dropouts are even higher in upper grades. So the effects are present. The problem is that these are present only in richer schools, and with higher family investments. So most vulnerable children still need of specific policies to reduce dropouts rather than just rules for social promotion, to be socially promoted. Thank you.
Great, thank you very much, Francisco, for finishing on time. I encourage everybody, if they haven't, to put questions in the chat so that we have a record of them for the presenters. We'll have a little bit of time at the end for other questions, but please do use the chat to introduce questions. Now we'll move on to our second paper on peer effects from networks, and this is presented by Bernardo Pincheira.
Can you hear me and can you see my screen?
Yes.
Okay. So, well, thank you for being here in this presentation. Of course, it's a pity that we couldn't meet in Perm, but thank you to the organizers for carrying on with this online format. Well, this is like first time I'm presenting this paper, so like all questions, suggestions are more than welcome. This is still a work in progress, so I value feedback from everyone. And well, this is peer. So I studied peer effects using network data, and I use data from a leading Russian university. I won't name the university, but I'm pretty sure that all the people attending this conference, I'm pretty sure that everyone is quite familiar with this leading Russian university without any need to mention the name of it. What's my motivation to? Well, so like peer effects is something that has been studied for a long time and in several contexts. I can mention myself as an example. I was presenting another paper on peer effects in Perm 2 years ago. But now I'm working with network data, and one motivation to use this data is that it gives you much more details on like connections that happen within a group, like for example within a class. And traditional studies rely on this assumption that the size of the reference group is the same for everyone in the class. So for example, like currently in the meeting we have like 25 participants. Since I'm not a peer of myself, it would mean that if, let's say, I take the list of everyone here and I run a study on peer effects, I would see that for every person attending, like the reference group would be like 24 people. So this makes quite difficult to separate, to identify separately endogenous from exogenous peer effects. Exogenous peer effects are those derived from like predetermined characteristics, while endogenous peer effects are those derived from effort or behavior. What's the main, let's say, advantage of using network data is that I can I can see like which people I actually interact with. So for example, if I need to name like the people who I work like in the same research center, I would name like Francisco, Ilya, and Polina who are here. So these are like 3 people, like with the other like 24 or well now 25 other participants, I do not work closely. And another good feature is that, for example, if we ask like Francisco to list who is he working with, and let's assume that he doesn't like me, so let's assume that he will list only Ilya and Polina, then like he will have like a reference group of only 2 people, which brings 2 important features. One, that we have variation in the reference group, and the other important feature is that we can also see like which connections are reciprocal and which connections are not. So for example, like if I name Francisco, but Francisco doesn't mention me, we will have like a non-reciprocal connection. But let's assume that I list Ilya as like a working partner, and if he lists me as well, then we have a reciprocal connection. So this gives us like more information that can be useful for identification of peer effects. So well, my main research question is like, what are the peer effects on academic achievement? I try to identify both exogenous and endogenous peer effects. And I look at I have information on like friendship type and reciprocity. What do I mean by friendship type? So well, in the survey that the students had to answer, they had to like list 2 types of connections. So in one question they were asked like, oh, like, please name like up to 5 people whom you connect or you communicate the most, which I will like label as loosely as friends. And another list was, okay, please list up to 5 people whom you rely to do like homework or to study. So this, I named them study partners. So for the sake of the presentation, I'm not aiming to be extremely precise with the language. I'm just trying to bring kind of 2 easy concepts like to carry on. And so yeah, it's possible like to distinguish by type of friendship or connection, and also it's possible to distinguish those connections which are reciprocal versus those who are not. And moreover, it's possible to see like in which direction the connection is going. And as I mentioned, I used data from a leading Russian university, moreover from a regional campus of this university that is relatively close to the Urals. As I said, I'm pretty sure that everyone is quite familiar with this campus, at least those who are here today, but I will not mention the name of the university. About the main sample analysis, I have in total, we observed like approximately 275 individuals, although like in the regressions, I will not have all of them. And so far I have data from like years 1 and 2 of their studies. And I have also prior information of like whom they have met before entering into university. A couple of words on identification. Well, the first like important paper to like study like peer effects with network data was with Bramouillet et al. 2009. And well, one of the assumptions mentioned in that paper is related to the network density, which basically like among the total number of possible connections within a group, how many connections are actually like happening. The density in my data is consistent with what they say that is needed for like a clean identification. Another important assumption is that conditional on observable characteristics, networks should be formed exogenously. I performed a similar test to Polina et al. 2016, and I do not find evidence to reject this assumption. A bit on the data. So the first row says score. This is like a weighted average of the different subjects that students have. So wave 2 corresponds to year 1, wave 3 corresponds to year 2. USC, Math, and Russian are like entry scores in mathematics and Russian. So these are like measures of like individual ability, if you want to think about. Then like this FR mean score is like the mean score of my friends. So like we can think of this as like the endogenous peer effect of my friends, as like then like the current like performance of my friends, and then the next 2 rows like the entry exams in Math and Russian of my friends. The next 3 lines the same for study partners, and also like a measure of proportion of female peers. In the year 2, I have fewer observations, partly because of dropouts. The regression equation. So my coefficients of interest are beta 1, which captures the endogenous peer effect, and beta 3, which captures the exogenous peer effect. So like the endogenous peer effects are like basically like for like the average current performance of my peers, but this captures that for each student, like there will be like a specific set of peers, which is not necessarily of the same size. And similar for like this is like for predetermined characteristics of my peers. Beta 2 just captures like individual controls, and I include like class fix effects. So I have like information from 4 different programs. I look at variation within each program only. For the sake of time, I will include only one of the several table of results just to keep it short and simple. So like the first 2 rows are like indicate like measures of individual ability. Then the rows 3 and 4 are like two measures of exogenous peer effects. In columns 1 and 2, I include like only exogenous peer effects, and well, with and without class fixed effects. And I can see that for Russian is significant, but only at the 10% level. Then in columns 3 and 4, when I include like endogenous peer effects, these are significant at the 1% level, and in the magnitudes they are like larger than the exogenous peer effects. This pattern is consistent like across like different waves, different courses, different like types of friendships. So like what is consistent throughout like all my regressions is that regardless if we're talking about study partners or about friends, regardless if we're talking about reciprocal or non-reciprocal connections, and regardless if we're talking about the first or the second year, the endogenous effects in all the cases are larger and of like a higher statistical significance than the exogenous ones. Why is this important? From a policy perspective, usually like the endogenous peer effects is more important because this arises from interactions between students. For example, if we think about behavior, and if we have network data, let's suppose that there's like one person who like interacts with many people, but this person behaves poorly. So it might be that this person will induce some poor behavior on many of his peers. This is more relevant than another person who is behaving poorly, but is not very well connected. So like with network data, it's easier to target some interventions, and endogenous effects, like let's say, are easier to adjust while you're working with a group, because exogenous effects in this case derive from characteristics that are already fixed. So it's like you may reallocate students, but you have, let's say, a limited pool of previous ability, for example.
About 2 minutes.
Yeah, thanks. What are like main limitations of the study? So, well, first, like measurement error. This is like quite, it touches most of the studies with network data. So like in this, in the survey, at least in most of the students like can list up to 5 people only. And if you want to list more than 5 people, this might induce measurement error. In practice, this may affect up to 10% of the sample. And also like dropouts, like without entering into details, is not the same as dropout that was not expected by the peers of this person versus dropouts that are expected. And well, as I mentioned, like so like endogenous peer effects are more important than the exogenous ones. I don't see any large differences between connections labels as friendships versus study partners. And also like I have some, I didn't show it here for lack of time, but I have weak evidence that reciprocal connections are more important than non-reciprocal ones. This makes sense, but I was expecting to see a larger difference, but it's not that much. So I hope I finished on time, and thank you for your attention.
You did great. Thanks, Bernardo. Our next paper is by Ilya Prakhov and Polina Bugakova, and it's on interregional accessibility of higher education in Russia.
Thank you. Polina will present our joint paper, and I will assist with the slides.
Okay, sure. So we can see our presentation well.
Yes.
Okay, thank you. Then we will start. So hello everyone, and today we're glad to present you our research on the interregional accessibility of higher education in Russia, which we are working on during the year and a half, I think. The next slide. And introduction of the Unified State Examination in 2009 was aimed at smoothing unequal access to higher education by making the admission procedure more clear and unified. But still, the accessibility of higher education can be various in different regions. And that is a special case for Russia, as we do have a uniform examination with uniform requirements, but the level of socioeconomic development of different regions is various, and the level of markets for higher education is different too. So our research contributes in making it more clear how regional characteristics may influence the accessibility of higher education in Russia in the context of USC. The next slide. And the purpose of current study is to assess the accessibility of higher education and to explain how different barriers can influence the accessibility of higher education directly and indirectly. First, based on the literature review, we constructed an analytical model that shows how different barriers can restrict the accessibility of education. After that, using data derived from the longitudinal study trajectories in education and careers, the cohorts of students which may encounter different level of the accessibility to higher education were identified. And after that, empirical models which assess the accessibility of higher education were tested. The next slide. So let's move on to the next part of our presentation. And here I will give you a definition of the education that can be considered accessible. If people can enter universities only because of their cognitive abilities, while their socioeconomic status does not influence each stage of the admission procedure, then such an education we can call accessible. However, accessibility of higher education can be restricted not only by cognitive characteristics, but also by family socioeconomic status, school and background, and even by regional characteristics. Next slide. So we took all these factors and constructed an analytical model, which you can see now. This model shows us that family socioeconomic status and school and background can influence both directly and indirectly. Direct effects are about parental involvement, parental ability to pay for their children's education, and it is also about information activities conducted by schools and so on. Indirect effects are about everything that can influence USC results. For instance, extra investments, extra help, quality of school education, and peer effects. And the regional characteristics can first influence these factors, and after them can have an impact on the USC results. Next slide. Our empirical model is based on the panel study trajectories in education and careers. We used a couple of the first waves, and that allows us to capture the educational strategies of the participants. So we know what they decided to do after the 9th form, if they entered the university, and if they did, then which university, and what's the selectivity level of that university. And indicators, as I have already said, that determine the accessibility of higher education are socioeconomic status, school and background, cognitive abilities, and regional characteristics. So we chose factors depending on the existing literature, incorporated them into our model, pulled data, and such a design of our research gives us an opportunity to assess and to test the empirical models. Next slide. So we selected 3 cohorts. First, Moscow citizens, because there is the most developed market for higher education in Moscow. Then large cities and regional centers, as usually some large universities can be located there. And finally, the last cohort, other settlements residents. And the first descriptive analysis shows us that Moscow residents are more likely to enter universities. After them, as expected, large cities and regional centers residents. And the last cohort is well behind and begins this backlog 2 years before the admission procedure starts in the 9th form. And as we can see, only 65% of other settlement residents go to the high school. That is 12% less than in Moscow. And the share of those who entered universities is also 17% less in other settlements in comparison to Moscow. The next slide. So our regression models assess the likelihood to enter universities and the likelihood to go to the high school. The first step model assesses the total effects, and we have also tested extra models which assess the production function in education. And such a specification allows us to assess both direct and indirect effects. And here you can see the first model about the likelihood to attend a high school. And we can see that Moscow residents face the least barriers while attending high school. More barriers restrict the accessibility of higher education for big cities and regional centers residents, and the least likelihood to attend high school is for other settlements residents. The next slide. Here you can see the second model, which assesses the likelihood to enter university, and the picture is the same. The greatest number of barriers face other settlements residents, while the least Moscow residents. Next slide. After that, we analyzed which universities people entered, looked at the mobility level, at the selectivity level, and we also analyzed the components from which university quality is compiled. But right now we'll miss this part as we don't have so much time. And anyway, all the models which assess the accessibility of higher education have been already shown. So we tested empirical models and found that, next slide. So we tested empirical models and found that USC in its form does not guarantee the accessibility of higher education. USC can play a role of mediator because exam results can be influenced by various factors. As Russian regions strongly rely on different macroeconomic characteristics, unequal access to higher education can be even aggravated in the regional context. And one reason Moscow residents have major benefits is a well-developed market for higher education. People have an opportunity to stay at the same region they live, and they also have significant opportunities of extra preparation. Region school graduates face problems arising from the need to move to a different region and a less developed market for higher education. The next slide here. And rural residents face major challenges due to the least developed market for higher education, low families' income, and low quality of extra preparation. Thus, we've developed some recommendations as neglecting this problem could even increase inequality. The next slide. Our recommendations can be divided into two groups, on the individual level and on the level of the whole society. So on the one hand, we recommend some support on the individual level for rural residents, for example, some grants that will cover some transactional costs while moving to a different region in order to enter university. And it would give us a high return to higher education on the individual level. On the other hand, we recommend to develop regional markets for higher education, for instance, through building effective communication between educational institutions in order to create spillover effects. And developing markets for higher education in regions is important because according to the human capital theory, it would enhance a high return of higher education on the regional level and even on the level of the whole country. So to sum up here, we just recommend to adopt some policies at micro and macro level. And here we have the end of our presentations, and we also have some time for questions.
Thank you, Polina. Rather than questions right now, we have the time at the end. So I'm going to go to our final presenter, that's Cornel Nesseler. And Cornel's going to talk about mapping barriers to social integration in Europe through a field experiment. Go ahead, Cornel.
Thank you very much for the introduction, Dennis. I hope everyone can see me and hear me.
Yep.
So Dennis, I don't know how many times you've seen this presentation. I'm sorry for you. There's nothing I can change about that.
I'm going to ignore you now.
Yeah, that's fine. Okay, So this is a paper I'm writing together with Helmut and Carlos, who both work at the University of Zurich. And as you see, our topic is a little bit different than the topics you've seen so far. We started this paper basically 4 years ago when we did a field experiment in Switzerland. And I'm going to come back to that experiment in a couple of slides. But after we did this experiment, we got questions once in a while, and they wanted to elaborate on how high is the discrimination we find. And this is the reason why we repeated our previous field experiment in 22 countries. So if you come from economics, you can ask yourself, or you can ask me, Cornel, great that you are doing research on social integration, but why should I care? Okay, so I go to the next slide. So why should you care? Because migration is an important topic, not only for social sciences, but for economics as well. So as you can see here are a couple of numbers. If you look at asylum seekers in the EU, but basically the point I want to make is nicely summarized in the next slide from a Swiss author. His name is Max Frisch, and he said, we asked for workers, we got people instead. So what does that mean? That means if people come to your country, they don't only work there, so they don't only participate in the labor market, but they also want to make friends. They want to maybe build a family, bring their family, so they want to live there. And this is what we mean by social integration. So we want to measure how high the chances are for people to be socially integrated into a country. Now, your next question might be, okay, great, but are there any other researchers who have done that before? And sure there are. So what these researchers normally do, and this is a problem in this area or in this line of research, is that they use survey data or survey information. And as you know, this data is almost always noisy. And I can give you some examples here on the next slide. So for example, they ask people how many times have you had interaction with natives, or they ask people, are you married and how old were you when you got married? Obviously, all those measurements are approximations regarding social integration. So for example, if you've had a lot of contact with natives, yes, maybe you're more integrated than someone who didn't have any access or any contact whatsoever with natives. But on the same side, when I go to my work here in Norway, in Trondheim, I have a lot of contact with natives, but does that necessarily mean that I'm well integrated? So this is the question. And because of that, we did a field experiment. And regarding our method, we're not the first ones to use this method. So in labor economics, this is a method that is widely known. And I would say that the first ones who started this were Bertrand and Muliainaton, so almost 16 years ago. And what they did is that they contacted employers in the US. They sent them CVs, and they had typical white American and typical black American names. And then they had a look at the response rate, and they saw that the response rate for black Americans is lower than for white Americans. This is a method that has been used for many different areas as well. So here's an example I like to use because I'm working in Norway. So you see the same method from Bertrand has been used in Oslo, so in Norway. And it's not only something for the labor market, but if you have a look at the very nice Edelman et al. Paper from 3 years ago, they use it for the sharing economy. So they use it for Airbnb. And there have been numerous approaches for different areas. So for example, someone used it for Uber, where they basically only changed the name, and then they had a look at what's going on. So what we are doing is that we use sports as a laboratory. Especially we use amateur soccer as a laboratory. What do I mean by that? And I can give you one practical example. When I moved to Switzerland for my PhD, that was some time ago, I applied to play field hockey over there, and I actually played field hockey, and that gave me access to many social gatherings in Switzerland. Now my colleagues who write this paper together with me still work in Switzerland, and Carlos is a member of a futsal club, and Helmut is a member of a tennis club. So this gives them access to social activities. But because I'm presenting this paper today here, I will say most of the crowd who's listening is in economics or business. I'm going to concentrate in depth on the method. So if you have any question whatsoever on the method, please let me know. So we did it in 22 countries, and I'm going to explain it, what we did on the example of the Netherlands. I like this because it's a very straightforward approach we did in the Netherlands. Most of the people know the Netherlands or have been there, so I think that's straightforward. So every dot you see there on the map is one club in the Netherlands. And for each club, we gather the contact of one coach. So remember, those are amateur teams. So every dot is one email address of one amateur coach. And what we did then is that we started gathering names, and we gathered typical native sounding names and typical foreign sounding names. So for example, here on the left-hand side, you can see the surveys that we did in those countries. So here, the example of the Netherlands, we had typical Dutch sounding names. So for example, Thomas van Dijk, that's a Dutch name. And then we asked people in the Netherlands, please categorize those names either into foreign names or into native names. And we used the foreign names for the three largest foreign groups in the country. So in the Netherlands, there was Germans, Algerians, and I think, I don't remember the other ones. So, and if they then correctly categorize those names, we take those foreign groups. So I give you here another example for a country where it didn't work out as we expected. So that's Belgium. In Belgium, the largest foreign groups are Italians, French, Dutch people, Moroccans, and Polish. But in Belgium, people cannot distinguish the names from people coming from France or the Netherlands. So that means we had to take the next largest foreign group. So we took Italians, but we had to drop French and Dutch people. So the next groups were people from Morocco and Poland. Here is the text that you see that we sent to every coach. On the left-hand side, you see the English translations. So this is the one we sent to the UK. On the right-hand side, you can see the actual Dutch translation of the English text. For each text, we got an official translation from the University of Zurich, because even though I speak some Dutch, we wanted to make sure that there were no typos in the text. So basically, we just asked for if we can come to practice. We are not giving away any other information, so no age or position related things. And we say that we've played on a similar level. So here is what we did in the next step. We used block randomization because in the Netherlands, you have some larger areas like Amsterdam, Utrecht, The Hague, or Rotterdam. And we didn't want some names to be crowded in specific regions. So this is why we randomized the names. And here you can see the example for one name. So that basically means that for this name, we contacted the clubs all over the Netherlands, but not in one specific region. And this is how the email looked like if someone got it. So you see that they received the name on the left-hand side, you can see that, of the person we thought of. So here it's Kaspar Wojcik, who's sending an email to a club, and they do not see the random 7-digit number. We had to get a Gmail account with a random 7-digit number because, as you can imagine, we cannot get a first and last name Gmail account for every name. So that's what the emails look like. And for the Netherlands, we sent out 778 emails, and in total, we sent out 23,000 emails. we had to send them out at the same point in time so that there's no distortion regarding our approach in the field experiment. And because of the ethical committee, we had to respond within 48 hours. And whenever we got a response, we had to say, thank you very much for your response. Unfortunately, I'm no longer interested. We were never allowed to disclose that this is an experiment. And afterwards, we had to delete all names and all individual data. So obviously, this is something that the ethical committee told us to do. Then we got the response from the coaches, and the responses were pretty straightforward. When we didn't get a response that's no, you cannot come to a practice, then once in a while we got a response that said, no, you actually cannot. So they wrote it down. Yes, you can. And yes, but how old are you? Or yes, what's your position? So basically we categorized them as negative or positive. So no response or no, you cannot, that's negative, and yes but is positive. So now if you think that 4 categories is better, that's fine as well. And we did perform our analysis also with those 4 categories, but it doesn't change the results. Here is an overview about the countries we took. So first we started with 25 countries, but we had to drop Bosnia, Ukraine, and Iceland. And the simple reason is that in all 3 countries, we didn't get enough observations. So whenever we had a country with less than 300 observations, we dropped this country. So in the end,
3 minutes.
Okay, I will try to hurry up a little. So in the end, we had to drop those 3 countries. So here you can see the clubs we gathered. So for all over Europe, as you can see, we didn't get clubs for Switzerland again, because we already looked at Switzerland before. And here I took out 4 countries, for example. So this is just to give you an overview. We took Germany, the Netherlands, Russia, and Spain. And as you can see, in all countries, foreigners get fewer responses than natives. And it's very interesting for me now to see that, because we submitted this paper a couple of months ago, and we got the responses from the editor, and the editor wants us to explain in depth how we interpret those results. And from a theoretical point of view, it's very difficult to comment on that, because our results are not in line with any previous theory, because we do not see that historically groups that were discriminated historically are more likely to be discriminated in our case. So for example, in Germany, Turkish people are normally more discriminated than Italians or Polish, but we don't see that in here. Then in the Netherlands, you would also see that Moroccan people are normally more discriminated, but we don't see that. And then we see that English people from the UK get fewer responses. In Spain also does not really fit classical theory that applies here. Okay, so this is, if you ask me, a senseless regression, because we put all the countries into one regression. So basically, do you get more responses if you have native sounding names? And if you look at the second row, native sounding names, yes, you see that if you put all countries into one regression, you get more responses, 10 percentage points, and 11 percentage points if you include the covariates. And then if you look at the foreign groups, so foreign group number 1 means this is the group with the largest foreign share in a country. That doesn't necessarily mean that you get more or less responses than any other groups. And here is an overview about the countries we did and the response rate in total. So the response rate natives and foreigners got. Normally, when it's interactive, I can tell you a little bit more about that. And here is the difference. So basically, have a look at the yellow and the blue line in here, and that's basically the difference between this line, and you see that the biggest discrimination is in Austria, Hungary, and Croatia, and the lowest one is in Ireland, France, and Portugal, and that's it. Thank you. So I hope I made it. Sorry for rushing through it in the end.
Thank you, Cornel. So we'll open up for questions from anybody, for any of the presenters, except for Francisco, who had to go teach, so he's not here. If you have questions for him, please do put them in the chat, which he will be able to see later.
I think there are questions to Bernardo. If you go through the chat and
thank you, Tatiana. Yeah, yes, I read the question. So, well, thanks to Maria for asking. So about the classification into exogenous and endogenous, no, it's not something I created. This is something that Mansky came up for the first time in 1993 with a seminal paper on peer effects. And the related question on how my results are aligned with the literature, well, as usual with peer effects, there's like mixed evidence. For example, like the paper that I mentioned in my presentation, Bramouillet et al. 2009, which is one of the first using network data, the results are more or less in line. So like, I don't have exactly the same data as them, but the main message is that endogenous peer effects are larger than the exogenous ones is more or less consistent with that. In terms of like that the type of connection does matter. There's like a recent study by Lavi and Sons 2018, and I think that in that paper, like the type of friendship seems more relevant than in my paper. I hope this answers your question.
Yeah, I was thinking that if you have found that exogenous are more important than, no, vice versa, endogenous are more important, maybe this is your contribution in comparison with the previous one.
No, I mean, no, this is like not a new result. Well, all this, I mean, like, I would say that more than 85–90% of the studies that I am aware of network data, they use data from the US with like from a specific data set. I would say that only in the last 4 or 5 years there have been like studies with network data from other sources, and at least like on the main message on endogenous versus exogenous peer effects, like it's kind of in the same line. I think I do have more information than other studies in terms of like the type of friendship, the reciprocity, and also that
okay.
I observe like this over time.
Mm-hmm. Okay, thanks,
Maria.
I guess there is also the question to Polina and Ilya.
Yes, thank you for the question, and this comment about student mobility and those who attend university in another region is also crucial. But in this version, so still there's a work in progress. We have not addressed this issue as we consider the larger cohorts of students, and here we focus only on the origin of the students. So for us, it's crucial to understand the differences in educational strategies for students depending on whether they graduated from Moscow, larger cities, or other settlements. But for now, we have as a statistics for the admitted students for the students' body. And for example, we have the following distribution for Moscow universities. So 70% of students are from Moscow, 13.6% are from large cities, and 16.2% are from other settlements. While in regional universities, I mean those universities which are located in large cities or regional centers, around 2/3 of students are from regional centers and large towns, and 35% of students are from smaller settlements. And students from Moscow do not migrate to the universities of other regions. So they stay in Moscow and they apply only to Moscow universities.
What about St. Petersburg? I mean, I know it's a large city. It seems like it would be interesting to see if people move there as well, or where their students went.
Yes, I agree with you, but unfortunately, for now, we do not have a large number of observations for St. Petersburg. As you can see, we have like 9% of the sample. So there are students who graduated from Moscow, and so it's only like 300 observations. So I'm afraid that for St. Petersburg, we will not have a sufficient number, but we do think to try to analyze another cohort of students from St. Petersburg, because this is also a large educational center, and this region is also well developed in the economic terms.
Thank you.
Right. I think we have a couple of more minutes to take questions or comments on presentations.
I have a question to Polina or Ilya. Like, I would say this is like not like this will not bring any improvement to your paper. It's just like a question that do you know if like the unified state exam aims to measure like more like, let's say, content or knowledge or abilities? And let me tell you why do I am asking this question. Like in Chile until like 2004 or 2003, there was like a admissions exam which was like the same for everyone, but was aiming to measure abilities. So it was possible for like students from like, let's say, coming from like low socioeconomic backgrounds or attending like poor schools, that still like they would succeed in this exam, because even though they didn't learn everything, since they had the ability, they managed to get to answer more questions. Then they changed this exam to like something that measures just content or knowledge. So like if you didn't see the material in the school, even if you're very smart, you're not able to answer. So my first question is like, do you know if this unified state exam aims to measure like more ability, more knowledge? And the related question is like, would it be possible that maybe changing the format of the exam would manage to decrease, to narrow the inequality gap? Because yeah, I saw your recommendations, and yeah, like improving schools quality, for example, in regions would improve this, but clearly this is something costly, and if it was feasible, I guess it would have been done in the past. So that's my question.
Thanks for your question. I can tell you as a student who passed this exam, and it is sure measures knowledge only, not abilities, and even more very specific knowledge. And if you didn't see the exam and the materials at the special sites, I'm not sure that you will pass it. So you have to prepare for that exam, not for the subject. And the second question was about the changes in the exam.
Yeah, I'm thinking that of course, like we would all like to have like good schools everywhere in Russia, but of course this is like a costly measure. I'm thinking that if the aim is to reduce to narrow the gap in inequality, maybe an exam which tends to measure more ability and not only content, that might achieve at least partly this result. I don't know if you have any comments if this is feasible or not at some point.
I think that it is possible in the exam which assess mathematical skills, but I'm not sure that exams on history or, for instance, social sciences can measure abilities rather than knowledge. And I think that the exam which can measure the abilities, it's not only mathematics exam, but also Russian language exam, where people can show how their logic works and so on. Maybe their grammatics, because students read books, so they don't have to prepare for Russian language exam. They just can show their abilities. But there are also subjects which were hard to make measuring abilities rather than knowledge. That is specific exams, for instance, history or social sciences. I don't know how to change them in order to assess the abilities.
Thank you, Polina. I'm sorry, one quick question to Cornel, if I do have some time. Well, thanks for your presentation. I might have missed it, so I apologize if you mentioned this in your presentation. So do you see like similar patterns of discrimination for countries who have like the same native language? I don't know, I'm thinking like, for example, Germany and Austria.
That's a good question, but no. For example, Germany is around 10%, and Germany and Austria is, I think, double. So, but still, Switzerland, I mean, the German part of Switzerland is somewhat similar to Germany, but in Belgium, in the Dutch part, you don't have the same discrimination as you have in the Netherlands. So no, I don't think there's a pattern, to be honest.
Okay, thanks.
If anyone has more questions, you can direct them to the presenters themselves. But we need to stop now for the closing remarks. And I see that Dmitry has shown up. So I think I'll turn it over to Tatiana and Dmitry to close out the conference today.
Right, Dmitry? Okay. While Dmitry is switching on his microphone, I would like to take a minute to thank all the participants and bring up important figures that would come up today. I think we owe this conference to the great participants. We had over 100 visitors, unique visitors to the conference, and that's the greatest success because of the virtual format, and almost a quarter of them were students and PhD students and top quality professionals from the fields. We've listened to 22 papers and a phenomenal keynote speech by Professor Michael Koetter. And I think we also would like to thank all these invisible support people behind the conference scenes, starting from Alexander and Anna from formatting the conference site, and Olga and Anastasia streaming the channels, and PR department with Nikita, Ekaterina, and Yelena. And our indispensable tech support, Igor Bradulin. Everyone at HSC knows him. First and foremost, we owe this conference to the inspiring leader and indispensable and fundamental to the success of this conference, Dmitry Vinogradov, who managed to bring this community of devoted researchers of applied economics and more domains than that. A couple of housekeeping things. Please know that you will be contacted from our marketing center for the feedback on the conference and comments by the speakers and participants as well, guests and moderators. Thank you so much. You made this conference come true, and your questions as well. And again, presentations, chat logs would be available. And if by some chance someone needs the certificate of attendance, please let us know. We would issue them. Well, and once again, my sincere thanks to the devoted people such as you. And I hope we'll see you in Perm September 2021. I know that moderators would like to take the floor and say a couple of words in closing remarks. Dmitry, Dennis, Paula.
I would like to thank the organizers for, the local organizers of this virtual conference for the smooth running of all the sessions. Because I don't know how it is done, but it was really seamless and everything worked and everyone could log in the session. Thank you very much for that.
It's a pleasure to work. Right, Dennis. Okay. All right, thank you so much. And as a final thing, if you could switch on your videos and wave the hands, I'll take the print screen.
Just sorry, Tatiana, I was not able to open the unmute. Now I am. So okay. I want only to thank you everyone for for participating in this conference, and all those which organized and made this conference in virtual mode possible. Thank you very much for all your effort, and let's hope that next year we will be in person, so to enjoy much more. Thank you.
Yes, we do look forward to the next year, next September. Again, wave your hands or smile. Okay. Thank you so much. Until next time.